Give me a moment, guys. Starting now and sometime. And people in the first row, you have come only today. You should have known what happened yesterday. Don't talk in the class. No one is asking you, why aren't you going home and staying here? If you sit in the class, you have to be in the class. ಮಾತಾಡಾಗಿದ್ರೆ ಬರಬೇಡಿ. Good afternoon, everyone. Welcome back to CA Foundation Accounting Marathon Revision. Today is day 3. So far, in the first 2 days, we finished first stage topics. We're still left with incomplete records, partnership, and company accounts. Let's begin with incomplete records. Let's do that one question which is there in our RTP on incomplete records. After we finish that one question on incomplete records, then let's go ahead to solve questions on partnership and company accounts. We'll discuss the concept as well as and when we are about to start the topic and then do the question on the same as well. So come on, let's start. Incomplete records. It's a newly added topic in our syllabus, and the uniqueness about this topic is it is not much unique from final accounts and NPO. The approach is going to be very much the same like I mentioned yesterday. You're going to identify two aspects and then go into record. In short, if I would have to tell, the entity has not maintained complete records. It's maintaining incomplete records. They maintain only one aspect of a transaction, or they've recorded the transaction in an incomplete manner. We have to help them take their financial decisions. That is based on preparation of their financial data. That is by evaluating financial performance and position. So how do we evaluate their performance and position? We need to prepare final accounts. So this can be done in two methods. First method is called a statement of affairs method. And the second method is called conversion to double entry system method. Under statement of affairs method, we don't prepare complete books of accounts. We prepare a statement of affairs which looks like a balance sheet, but it is not balance sheet. And then we prepare statement of profit or loss, which is like P&L account, but actually not P&L account. And this will help us identify our profit. In our balance sheet, we'll find that item which looks like balance sheet, statement of affairs. We write all the asset balances and liability balances to identify the capital as balance and figure. Once we find capital as balance and figure, and we know the capital as on the previous balance sheet date and capital as on the new balance sheet date, that is capital in the old statement of affairs and capital in the new statement of affairs, we will see the journey of the capital from the opening capital to closing capital. The journey of the capital from opening capital to closing capital is plus additional capital minus drawings plus interest on capital plus profit. So we'll try to write the values of all other objects to find the profit figure as balance and figure. And that's the pattern. So let me show that. And if there is a question in RTP on this topic, let's do that. Incomplete records. See, like I told you, we'll prepare something called statement of affairs, which is like balance sheet, but not balance sheet. And in that balance sheet, we'll determine our capital. Once we determine our capital, we know that the journey of opening to closing capital is opening capital plus additional capital minus drawings plus profit, which is equal to closing capital. The logic that we use is we keep this profit up there and shift this opening plus additional capital minus drawings below closing capital. It will become opening capital, closing capital minus opening capital minus additional capital plus drawings. So when I do that, I'll actually identify the profit. Profit is found by difference between capitals, and capital is found as a balancing figure in statement of affairs. Now let's see if there is a question on this in our recent RTP. If there is a question, we'll do the question from the recent RTP. If not, we'll pick a question from our study material and then solve it. Final accounts. Then we have incomplete records. Ankur. So there we go. Ankur keeps his books of accounts in single entry system. However, he is able to give you the following list of assets and liabilities. Do they want us to do statement of affairs method or double entry system? So Ankur withdrew during the year. No fresh purchase of machinery is made. So they haven't given much of information. By this information, there is not enough information for you to open trading account, P&L account and balance sheet. This is a question on preparation of financial statements under statement of affairs method. So shall we solve this question from our from our recent RTP? Very good. There we go. Come on, let's start solving in the books of Ankur. Ninth one done. Yeah, there we go. 10th one. Incomplete records question from our RTP in the books of Ankur. We are trying to prepare statement of affairs. So we'll not prepare two statement of affairs. We'll prepare one statement of affairs with two columns. I'll write statement of affairs. I'll write liabilities. Amount column, I'll draw two amount columns. One amount column for previous year, one amount column for current year. Rather than previous year, they've given it as opening closing. So let's continue the same. 1st April 23, 31st March 24. So this becomes liability side. Same to same, I'll write it on my asset side also. There you go. Liability side is ready. I'll now create one on asset side. This is our statement of affairs. I told you I'll prepare statement of profit or loss also. Statement of profit or loss. What do we do in our statement of profit or loss? Let me write particulars. And amount column. And like I mentioned, when we open statement of profit or loss, we are not going to do expenses, income, excess of income over expense. No, not that story. We're going to find difference in capital as our statement of profit or loss profit. We'll start with closing capital. From this closing capital, I am going to deduct opening capital. I am going to deduct additional capital, and drawings would be usually deducted. No, if we start with opening balance, now I am going to add drawings, and if there is interest on capital and interest on drawings, we are going to adjust them as well, ultimately to find profit. Yeah. Now can I read the question and post one item at a time? Start with the question. To begin with, we have cash in hand, cash at bank, 1,750 and 20,000. This is my opening balances. I'll write in my opening statement of affairs column, cash in hand and cash at bank. How much is cash in hand? Opening balance 1,750, closing balance 1,400, and cash at bank is 20,000. So let me write 20,000 cash at bank, opening balance. Closing balance, we aren't aware. Then bank overdraft. Bank overdraft is a liability. I'll write on the liability side. Bank overdraft. How much is the liability? Opening liability is 0, closing liability is 1,800. After bank overdraft, then we have bills receivable. Bills receivable, opening is 15 and closing is 25. I'll write on the asset side, bills receivable. Opening is 15,000, closing is 25,000. After bills receivable, we have stock. Stock is also asset. Let me write stock. How much is stock? 93,500 each. 93,500 is asset. 98,700 is asset. Closing balance. After stock, they have given us debtors, which is asset, 60 and 70. Opening balance of debtors is 60,000. Closing balance of debtors is 70,000. After debtors, we have furniture and fittings. Let me write furniture. Furniture and fittings. Opening balance of furniture and fittings is 65,000. Closing is also 65. That actually sounds like there is no purchase, there is no sale, there is no depreciation. If you can recall, in the adjustments, they've given something relating to furniture. Is there furniture? Yes, depreciation is there on furniture. So what do? Actually, I won't be writing 65,000 closing balance here. In fact, this debtors also I shouldn't be writing 70. For time being, let me write 65. But remember that these two are incorrect. We have to change these values. Debtors would have to identify the new provision, deduct it and then write. Furniture I'd have to do depreciation and then write. Let's keep it there till now. But you should remember that these items will have adjustment. After I finish my furniture, creditors is 45 and 31. Let me write on the liability side, creditors. Opening creditors is 45,000 and closing creditors is 31,000. After creditors, we have bills payable. Opening bills payable is 5,000, closing bills payable is 0. After bills payable, let's read the adjustment. Ankur introduced 10,000 as fresh capital on 1st of October 2023. This is additional capital. Whenever there is fresh capital of 10,000, additional capital, let me write as minus 10,000 here in determining my profit. Usually journey is opening plus additional capital minus drawings plus profit is equal to closing. To find profit, all the minus items which is there will be shifted to other side. If you did not understand this, remember, opening plus additional capital minus drawings plus profit is equal to closing. What are we going to do now? Now, our closing will be at the place where it is. Our closing will be exactly at the place where it is. I am shifting all of these items. All of these items to the other side. When I shift them to the other side, opening which is positive will actually become minus. Additional capital which is again add will become minus. Drawings which is minus will become add. All of this to find what? We're trying to find profit. These items when they go to the other side, it becomes negative. And that's the reason I've written additional capital as minus 10,000. After additional capital minus 10, he also withdrew 5,000 every month for his household expenses. So 5,000 rupees into 12 is the drawings. 5,000 per month multiplied by 12 months. Can I say that comes to 60,000? ₹60,000 is our drawings. Then the line of the information says during there is no sale or purchase of furniture. So opening balance of furniture will be closing balance, only subject to depreciation is the new item. Ascertain the profit for the year after depreciating furniture by 10%. So depreciation has to be provided on furniture by 10%. 65 is the value. Let me write 65,000 minus 10%. 65,000 is opening value. Closing value is after deducting 10%. So it will be 65,000 minus 10%. That is nothing but 6,500 has to be deducted. 58,500. And debtors, there is an adjustment. What is the adjustment for debtors? No, don't try to think 1,500, 6,500 depreciation. I'll write in P&L account debit side. We are not doing double entry system. Are we doing double entry system to identify that? No, no double entry. So we're trying to identify the profit without the following double entry system. Without following double entry system. Then provision is to be made on debtors for bad debts. By how much? 5%. So right now the debtors are 70,000. 70,000 is before provision. 70,000 is before provision. So I would do a small working note here. Debtors before provision. 70,000 less provision for bad debts. How much is provision for bad debts? 5% of 70,000. We get 3,500. Am I right? So what do we get? Debtors after provision. $66,000, and I would write 66,500 in my statement of affairs here. Now the entire question is over, and here also I have written the full data. All that I need to do now is identify my capital as balancing figure. Here it would be 2,55,250 minus 50,000. It is 2,05,250. Similarly, we will find capital for our closing balance. 2,17,300 is what we will get. Here cash at bank closing is 0. So 2,05,250 is opening capital. 2,17,300 is closing capital. Let me write here closing capital of 2,17,300 less opening capital of 2,05,250. If you do that, 2,17,300 minus 2,05,250 minus 10,000 additional capital, add 60,000 rupees, which is our drawings, and we will be finding our profit. $62,050 is the profit. So this is statement of affairs method. However, instead of doing this nonsense of identifying balancing figure in balance sheet, we are identifying balancing figure in balance sheet, which is actually not an appropriate method. If we decide to do trading account, P&L account, balance sheet in detail, considering double entry aspect, that is conversion of single entry to double entry. Do you all get this? If you would want, I would do one question on conversion of single entry to double entry. We say it's all fine, then we'll go forward and then start with partnership. You want to do one question? Come on, let's do one question on conversion of single entry to double entry. This question, rather than doing a question which I like or something, let's do the question from our recent MTP. Mock test paper, let's see, there should be a question. In mock test paper, whichever question is being asked, that question is what we'll do. I won't ask you people to suggest, because each of you will suggest one question. Then I'll have 5 questions and don't know which question to do among those 5. June 2024, Foundation Mock Test Series 1. Official announcement is there. Oh, is the first mock test not yet over from institute side? Over, not over? Okay, you should have the paper here then. Announcement allidiva. Download question paper. Log into BOS knowledge portal. Oh, I have to log into download. So I can't download. Only you can download because you are a student and I am not. Let's take a moment. Let's download the paper from some website. Henry, you have it? Telegram ಅಲ್ಲಿ ಕಳಿಸ್ತೀರಾ? ಕಳಿಸಿ. Have you seen that question MTP? ನೋಡಿದ್ದೀರಾ? None of you have seen. How is it? ಚೆನ್ನಾಗಿದೆಯಾ? ಮಾಡೋಣ. ಇದೆಯಾ conversion of single entry to double entry question? ಯಾರ್ರೀ ಅದು ಪೇನು? ಎಲ್ಲಿಂದ ಬರ್ತಾರೆ ಇವರೆಲ್ಲ? ಗುಡ್ ಆಫ್ಟರ್ನೂನ್ ಮೆಸೇಜ್ ವಾಟ್ಸ್ ಗುಡ್ ಬ್ರೋ ಅಂತೆ ಕಾಟ ಕೊಡಕ್ಕೆ ಬರ್ತಾರೆ. ಬೇಡ ಕೆಲಸ ಇಲ್ವಾ ನಿಮಗೆ? ಓದೋದಿಲ್ಲ, ಓದೋರಿಗೆ ಓದಕ್ ಬಿಡೋದಿಲ್ಲ, ಖುಷಿಯಾಗಿರೋದಿಲ್ಲ, ಖುಷಿಯಾಗಿರೋರಿಗೆ ಖುಷಿಯಾಗಿರಕ್ ಬಿಡೋದಿಲ್ಲ. ಕಳಿಸಿದ್ರಾ? ಗ್ರೂಪ್ ಅಲ್ಲಿ ಕಳಿಸಿದ್ಯಾ? ಹಾಗೆ ಕಳಿಸಿದ್ಯಾ? ಯಾ ಓಪನ್ ಮಾಡ್ತಿದ್ದೀನಪ್ಪ. ದಿಸ್ ಇಸ್ ಟುಡೇಸ್ MTP ಅಂತ ಕಳಿಸಿದ್ದು ನೀನೇನಾ? ಅಲ್ಲ, June 2024. ರೋಹಿತ್ ರೆಡ್ಡಿ. ಯಾ ಐ ನೋ. First April 2024, 29th April paper. We found it. Yes. ಸಿಕ್ತು. There we go. We found the question. It's here. Can we start? This is our mock test paper April 2024 issued by ICI, conducted on 29th of April. Let's see the question. From incomplete records, suspense account, this is rectification of errors, TINA, this is passbook question, BRS. Lucky does not maintain proper books of accounts. There we go. However, maintains and records his bank statement and transactions, and is also able to give the following information from which you are required to prepare his final accounts. Okay, let us prepare his final accounts. Shall we? To begin with, they've given debtors opening balance and the closing balance is missing. So what would I do? I'll open debtors ledger. Creditors opening balance is missing, closing balance is available. I'll open creditors ledger. Stock will not open something called stock account. Stock I'll open trading account. Bank balance I'll write in bank account. I'll open one bank account as well as fixed assets account. Then each of the transactions I'll go on reading them and then posting them. No cash transactions took place during the year. Goods are sold at cost plus 25%. Cost of the goods sold is 26,000, 2,60,000. Ashtena. And they want you to prepare final accounts. Time pass ತರ ಇದೆ. Why time pass ತರ ಇದೆ? They haven't given too much of information. Very little information. Solution to question 3A. from MTP, April 2024. Later I'll put the question also here so that you wouldn't have any doubts as to where did the question come from. Give me one moment. Let me get the data sorted. Yes. That I can't discuss here today. That we'll have to discuss separately some other day. We'll do that some other day. Balance sheet. The format of balance sheet is ready. Now let's also keep the format ready for our trading P&L account. Shall we? So here I'll start with my trading and profit and loss account. You guys can solve this question along with me instead of sitting idle and waiting for me to solve and looking at what I do. Particulars. Draw the format of trading account for an entire page and the format of P&L account, trading P&L account in one page, balance sheet in the very next page. And we will be preparing minimum 2-3 ledgers. That will come in the third side of the page. Debtors account. There we go. Format ready for our trading P&L. Let's begin. This is in the books of Lucky, who doesn't maintain complete books, and we are trying to help him by preparation of his final accounts. In the books of Lucky. In the books of Lucky. To begin with, they've given us debtors balance. Opening balance is 1,02,500. Closing balance is missing. I will write debtors balance in my debtors account to balance brought down. How much is the opening balance of debtors? 1,02,500. And I'll also write this in my opening balance sheet. This is balance sheet as on 31st of December 2023. I need to prepare balance sheet as on 31st of December 2022 also. Why should we prepare another balance sheet? If we don't do that, how would we get to know the capital? How would we get to know the capital? To know the capital, I have to prepare another balance sheet. Balance sheet as on, or have they given 1st January? Yeah, I'll name it as 1st of January 2023. Debtors as on 1st of January 2023 is, that will go in my opening balance sheet. Debtors as on 1st of January 2023, 1,02,500. Closing balance is not 0. Closing balance of debtors is not 0. Closing balance of debtors we would have to find. That is not 0. That's question mark. Remember, there is going to be balance carried down, and we are going to find by balance carried down of debtors using lot of other information. Next line of information, creditors. Opening can be 0, but I'm not telling you it will be 0. Can be. Closing balance is 46. So I'll open the next ledger called creditors account. Opening balance will come on the credit side because it's a liability. I'll write balance brought down, which I don't know. I'll write to balance carried down is going to be 46,000. And let me write the same in our respective balance sheet. So in the opening balance sheet creditors, I don't know the amount. I'll leave it blank. In the closing balance sheet, I'll write creditors. How much is creditors in closing balance sheet? 46,000. Then I have data of stock. Stock opening is 50, closing is 62,500. So in the opening balance sheet and closing balance sheet, let me write stock. This is closing balance sheet, 31st of December 2023. Stock as on the closing date is 62,500. Stock as on the opening balance sheet date. How much is opening stock? 50,000. I'd write this opening stock and closing stock in my trading account. Let me go to trading P&L account. To opening stock. How much is my opening stock? 50,000. Then I'll write our closing stock by closing stock. How much is closing stock? 62,500. So we've written everything in the place where it belongs. Have we? After we write this, then bank balance, opening balance is 0 or we don't know, and the closing balance is 50,000. Let me write bank balance. Closing balance is how much? 50,000. Opening balance, as of now, we don't know. Then I'll open one ledger called bank account. Bank account. In the bank ledger, let me write to balance brought down. Opening balance missing. Balance carried down is going to be 50,000. Opening balance we don't know and the closing balance is 50,000. What is after this bank balance? Fixed assets. Opening 7,500, closing 9,000. So let me write it in the respective balance sheet. Fixed assets. How much is the opening balance of fixed assets? Opening balance of fixed assets 7,500, and in the closing balance sheet fixed assets is 9,000, and there's difference 7,500 to 9,000. That difference can be purchase, need not be only purchase. There can be purchase and sale, there can be purchase, sale and depreciation, there can be only purchase and depreciation. We don't know. So what do? I would want to figure it out. I'll prepare a ledger. That is the easiest way to figure it out. You might think lot of shortcuts will work. I'll remember, I'll add this, I'll deduct that. Don't try that in the exam. In the exam, always fall back and take the cushioning of ledgers. That is the easiest and simplest approach. And don't worry about time. Really don't worry about time. Not doing will cost you 3 months. Doing it will not cost you. You would have enough time to prepare ledger. You wouldn't have too much shortage of time that you can't even open a ledger account. So these opening and closing balances are posted now. As I scroll down, I'll identify bank balances. Received from debtors 3,40,000. Because they haven't given any cash column, I'll assume that all the transactions are happening through bank account. We received 3,40,000 rupees from debtors. When I receive 3,40,000 rupees from debtors, journal entry is bank account debit to debtors account. Do you agree with me? In bank account, I'll write debtors account. In bank account, I'll write to debtors account. How much have you received? 3,40,000. So in bank account, I've written to debtors. Now I'll go to our debtors account. In debtors account, I'll write by bank account. How much? 3,40,000. In our debtors account, I've written by bank account. What is after that? Additional capital brought in 5,000. Capital has been additionally introduced. Journal entry will be bank account debit to capital. Bank account debit to. In our bank account, I will write on the debit side to capital. How much is the additional capital brought in? 5,000. I'll write 5,000 debit in bank column. This 5,000 is being additional capital brought in. Our capital in the balance sheet will increase. I'll take you all to our balance sheet. In our balance sheet, I'm going to say in our closing balance sheet. I don't know how much is the capital. We'll find it from opening capital, opening balance sheet. To this, I will add additional capital. How much is additional capital? 5,000. Where do we get our opening capital from? Opening balance sheet as balancing figure. So I'll give little space for that and add our additional capital 5,000 here. What's after additional capital of 5,000 being written? Sale of fixed assets 1,750. Book value is 2,500. Fixed assets of book value 2,500 is sold for 1,750. So we are having slight loss also. Remember, let me write here. Book value of assets sold 2,500. Then sale value is 1,750. So remember, our sale value is lesser than book value. So because our sale value is lesser than book value, we are going to make loss. How much loss? 2,500 minus 1,750. 750 rupees of loss. And what would be the journal entry for this? Journal entry for this is cash, or no cash here, bank. Bank account debit. How much money are we receiving? 1,750. And I am going to credit my fixed asset. Fixed asset account credit will be 2,500. This difference, what is there? No, 2,500 and 1,750. This 750 loss will be debited to profit and loss account. This is the journal entry. Being fixed asset sold at loss. If in case I have to post this journal entry in my fixed asset account, I would have to write by bank and by P&L. In my fixed asset account, I would have to write by bank account and by profit and loss account. By bank account is 1,750. By P&L account is 750. Now, in my fixed asset account, I have written by bank 1,750. In bank account, I will write here two fixed asset. How much did we receive? 1,750. And in fixed asset account, other than writing by bank, I have written by P&L. In P&L account, I would have to write two loss on sale of fixed asset 750. I'll go to P&L account. This is my trading account. My trading account will end here. And this is my P&L. Let me write it to loss on sale of fixed asset. How much was the loss? 750. 750 rupees loss is debited to P&L account. And by this, I am done with this sale of fixed asset transaction. Paid to creditors 2,80,000. If you pay money to creditors liability will decrease. Creditors account will be debited and our bank account will be credited. So the entry is creditors account debit to bank. In creditors account, like I mentioned here, I'll write to bank account. How much? To bank account in creditors account. 2,80,000. In creditors account, if I write to bank 2,80,000, in bank account I'll write by creditors. How much is the amount paid? Creditors liability is decreasing, debit. Bank balance asset is decreasing, credit. Both are done. Got it? What is after this 2,80,000? Then we have expenses paid 49,250. We are assuming that there is no outstanding, no prepaid expense. Why? They haven't given. If it was, they would have given some outstanding or prepaid expenses, opening and closing balances here. We would have opened ledger for expenses. Now, like how we did in NPO's question yesterday. Here they haven't given any adjustment. How much ever paid, so much is my expense. It will go to P&L. Journal entry for expense paid is expense account debit to bank. In bank account, I'll write by expenses. How much is the expenses paid? 49,250. And this being expense, it will go to my P&L account. In my profit and loss account. In my profit and loss account, I'll write debit side to expenses. How much is that expenses paid? 49,250. What is after expenses of 49,250? Then we have personal drawings of how much? 25,000. To the extent money is drawn, capital will reduce. Capital account debit, bank account credit. So the entry is capital account debit to bank or drawings account debit to bank. In my bank account, I would write on the credit by drawings account. How much is the amount withdrawn? 25,000. So in bank account I have written by drawings. In my balance sheet, below my capital, wherever I have no opening capital plus additional capital 5,000, I'll write here minus drawings. How much is drawings? Minus drawings 25,000. By this drawings adjustment also done. Then last one, purchase of fixed assets 5,000. So when you purchase fixed assets for 5,000, journal entry is fixed assets account debit to bank. In fixed assets account, I'll write debit side to bank account. This is purchase. How much is the purchase? 5,000. Correct, Allah? Then in fixed assets account, I'm writing to bank. In bank account, I'll write by fixed assets. $5,000. Done. Fixed assets transaction is also over. Now let's see the last adjustment. No cash transactions took place during the year. That is the reason we have not opened cash account. Opening balance of cash is not there. Closing balance of cash is not there. We are assuming that all the receipts are in through bank. All the payments are through bank. Goods are sold at cost plus 25%. Goods are sold at cost plus. So take a note of this one. Cost. Then profit. Cost is 100. Profit is 25. Sale price is 125. Profit is percentage of cost 25. Profit as a percentage of cost is 25. Sale is 125. So on sale it is 20%. On cost it is 25%. Actually we don't want to see that relationship also. We can do it without identifying that relationship. Just write like this and then we'll do cross multiplication later whenever we get information. What is the next piece of information? Goods are sold at cost plus 25%. Cost of goods sold was 2,60,000. So cost is 2,60,000. What is the price at which we have sold? We can find it now. 2,60,000 is 100. Do cross multiplication. 2,60,000 multiplied by 125 divided by 100. 3,25,000. This is one way. The other way is do 2,60,000 is cost. No. Do into 25%. Do into 25%. 2,60,000 into 25%. 65. Add 65,000 to 2,60,000. 3,25,000. So this is GP. This is sales. You add 25% to the 2,60,000. What will you get? What will you get? GP. You add GP and cost, you will get sales. So this 65 and 3,25,000 will help us in closing our trading. Do you get it? Come on, let's go to our trading account. In my trading, let me write here to gross profit. How much is this? 65,000. We've done working note. And I'll write by sales. How much? 3,25,000. How much did we find? 3,25,000. As simple as that. 3,25,000 is sales. Now I'll write it in the other places also. My GP I'll bring down here. I'll write by gross profit brought down. Here this is gross profit carried down. How much is the gross profit brought down? 65,000. And the sales 3,25,000. Let us assume that there is no cash sales. Entire sales is going to be credit sales. In my debtors account, I'll write on the debit side to sales. How much? Assuming No cash sales. Why? They haven't given any information. So when they don't give, we'll assume cash sales is 0. Sir, can we assume credit sales is 0? Yeah, when you're mad, you can assume so. See, they've given debtors account. When there is debtors, opening balance, closing balance, how can the cash sales, how can the credit sales be 0? It can't happen. So credit sales is there. Credit sales is pakka. Doubt illa. Ide. What is after that? Question is over. Question is over. Now we can close each of the ledger one at a time. Come to trading account. Do we have everything to close? We have opening stock, we have sales, we have closing stock. We don't have one item. Purchases. But we can find purchases as balancing figure. Why? Everything is there, no? So let's take the total. It is going to be 3,87,500 here, 3,87,500 here, 3,87,500 minus 50 minus 65,000. Purchases is 2,72,500. In the absence of specific information, we are assuming that cash purchases is 0, entire purchases is credit purchase only. So 2,72,500 purchases I'll write in my creditors ledger. In creditors account, I'll write here by purchases. How much did we find it? 2,72,500 purchases found from trading account. Then trading account is complete. GP is written. I will not find my net profit right now. I will wait. Why? What if there is some item during our ledger closing, some expense which will come? So we will keep this pending. We will not write it. And our capital cannot be closed. So we have net profit to be added. Only after we add our net profit, we'll get the closing capital balance. And we again don't know our opening capital also. That will be found in our opening balance sheet. And our opening balance sheet is not yet closed. There might be some balancing figure from ledger which will go to this balance sheet. So we'll close the balance sheets at the end after we close other ledger accounts. Come to debtors account. Opening is there, sales is there, payment is there. Balancing figure is balance carried down. Closing balance. Shall we identify our closing balance? I would say it is 427,500 minus 3,40,000, 87,500 is closing balance. This should go to our closing balance sheet. Shall I write in my closing balance sheet 87,500? See here, closing balance sheet, I'll write 87,500. This is our debtors. One item will go to balance sheet. Balance sheet will become ready by itself. Debtors over, creditors. See, there is opening missing. What is missing? Opening is missing. But we have purchases, we have payment, we have closing. So opening will be found as balance and figure. Don't tell opening is 0. Don't tell opening is 0. Opening is something that we just find. 326 minus 272,500. 53,000. This will go to our opening balance sheet. And this is the reason why I didn't close my opening balance sheet. And I was waiting to finish ledgers. 53,500. Come on. This is our opening balance sheet. On the liability side, I'll write 53,500. Correct? Huh? Is it 53,500? 53,500. Creditors ledger closed. Bank account. Opening balance is missing. Rest everything is there. All the payments are on, the receipts are there. Sir, what if there is one more receipt or payment missing? No, all the cash transactions and bank transactions should be made available. So only thing that's missing there is our opening balance. See, we were under the misconception of thinking that opening balance is 0. Correct or not? I told you not to. Opening balance is 62,500. Where would this 62,500 go to? That will go to our opening balance sheet. Shall I write 62,500 in the opening balance sheet? Come to opening balance sheet, and in the opening balance sheet, I will write bank balance as 62,500. Done. I think that was the last ledger, or is there another ledger? Oh, fixed assets ledger. Fixed assets. Opening is there, then purchase is there, sale is there. One item on the credit side is missing. This will be depreciation. Why? Opening over, purchase over. Still there is decrease. Credit side. What will it be? Am I right? Depreciation. How much will be depreciation? 12,500 minus 750 minus 1,750 minus 500. See, we found depreciation of 1,000 as balance and figure. This depreciation will go to P&L account debit side. Come to our profit and loss account. And in the profit and loss account on the debit side, I'll write depreciation. How much? All the ledgers are closed. We can find our net profit here. Net profit is, here the total is 65,000. I'll take 65,000 and from that I'll deduct the other items to net profit carried down. This is going to be balancing figure. I'll take 65 minus these three items. 14,000 is our net profit. Am I right? This 14,000 of net profit I will add to my capital here. 14,000. Then opening capital is still not written. Opening capital is still not written in the closing balance sheet. Where do we get that opening capital from? We'll get that opening capital from opening balance sheet. Here 2,22,500 is the total on the asset side. From that I'll deduct 53,500 to get 1,69,000 rupees as my capital. Got it? This 1,69,000 whatever I just found as my capital, I'll write it in the balance sheet 1,69,000. Check what is the capital closing and check out our balance sheet also. Capital total comes to 1,63,000. That is 116 in opening capital plus additional capital 5 minus drawings of 25 and net profit of 14. To that 163 if you add 46, 2,09,000 is the value at which both asset side as well as liability side will tally. Will match, and that's what we mean when we say it tallies. Cash is not there. Bank balance if you have to see, it's here. Today once the session is over, I'll share this entire PDF with you people. And for the benefit of people who don't have access to this, let me do a small favor. You can thank me later. I'll share this also in the same sheet. I'll put the question here only. So 10 marks question in the examination. Doable? Isn't it easy? Any part that you would want to see or have a doubt, please ask. If not, we will start with partnership. Clear with this? Trading and PL account is here. If anyone has any problem, balance sheet, closing, balance sheet, opening, debtors and creditors account. Once you are done with debtors and creditors account, bank account, then fixed assets ledger, lastly sale of the asset and profit, gross profit computation table. There we go. Entire question is over. Can we take a short break of 5 minutes, and on the other side we will start with the topic of partnership accounting. Yeah, short break, 5 minutes. Point 1, partnership accounting. Let us not waste too much time on introduction. Introduction ಸ್ವಲ್ಪ ಬೇಗ ಹೋಗೋಣ. So we'll spend time elsewhere. 10.1, introduction to partnership. So let's not do too much of basics, but we all know partnership is an association between two or more persons who come together for the purpose of sharing profits or losses, where the activities are carried on by all or one of them are acting for all. We know that maximum number of partners as per section 464 of Companies Act is 100. However, as per company rules tells that a partnership firm cannot have more than 50 people. Companies Act is telling how many people should be there in partnership. How does it say? It says that if you have more than 50 or more than 100 in the by rules and by act, if you don't register yourself as company, you will be called as an illegal association. So that's the reason why you are enforced to register as a company. And this provision, there is a provision where there can be a partner who will be partner only in the case of profits. Partner in the case of profits only is an option. And there is also a provision to be an inactive partner, a dormant partner. Got it? So what do you mean by partner? Is a natural person. Partnership is the association or relationship between partners. Partnership firm is the name under which they do business. And what is constitution of partnership? That is the partnership deed. It can be either oral or it can be written. And the terms of the partnership will be written in the partnership deed. If there is no partnership deed, there is no possibility of registration. If there is no partnership deed, there is no possibility of registration. If you don't register your partnership deed, then outsiders can sue you, but you can't sue outsiders. And even if you have a fight among yourself, you can't sue each other because there is no base, no. You get it? You can sue outsiders for an amount not exceeding 100, which is again a provision which is of not any significance. And what are the contents that will be there in partnership deed? You would have to write name of the firm, address of the firm, name of the partner, address of the partners, what is the business that you do, what is the profit sharing ratio between the partners, what should be the clause for capital contribution between partners, how to deal in the case of admission, retirement, death of a partner, when will the firm be dissolved, and how to compute the goodwill of the partner, and all of these terms including interest on capital, interest on drawing, salary, all this will be given in partnership deed. If in case you don't have partnership deed or you have a partnership deed but it doesn't talk about certain aspects, then you have to follow section 13 of Partnership Act 1932. Section 13 talks about model partnership deed. So by default section 13 will be applicable when you don't have partnership deed or when you have partnership deed but it doesn't talk about this aspect. As per section 13 of Partnership Act 1932, profits are to be shared equally between partners. There is going to be nothing other than equal ratio. You cannot say one partner will earn more than the other partner. If you have to give a higher share to one of the partners because he is active or because his contribution is more, then you would have to mention it in the partnership deed and then get that partnership deed authorized and notarized and registered. And next thing, no partner will get salary, no partner will get interest on capital, and no partner will charge interest on drawings. So no remuneration, no interest on capital, no interest on drawings. If in case any partner has contributed any money over and above the capital to the firm, that will be treated like loan taken by the firm from the partner. For the loan taken by the firm from the partner, we are going to give interest at 6% per annum simple interest to that partner. This is the common clauses that is given in Partnership Act 1932 section 13. One last thing that it also says is that all the partners will have equal rights and responsibilities. No partner has higher right or higher responsibility than the other partner. Everyone is equally liable. Got it? Then is P&L and P&L appropriation account same? No, they are different. This is important. If you don't do this, you can't start with anything else in partnership. You need to understand. P&L account is the place where we write all the expenses. These items will be acting as a charge against the income. This will reduce the profit. However, what we call as appropriation items is not charge against income. It is utilization of the profits that is earned. Charging interest on capital to the partner and collecting it from, paying interest on capital to the partner. It is not expense in P&L. After we get the profit, it's a way in which we'll distribute the profit back to the partners. So interest on capital is a P&L appropriation item, not a P&L item. Depreciation is a P&L item, not a P&L appropriation item. P&L items are to be written whether there is profit or loss. It doesn't matter. After we write them only, we'll identify if there is profit or loss. However, P&L appropriation is done only if there is sufficient profits. If there is no sufficient profits, you are not going to appropriate profits. Example for items what will appear in P&L appropriation account are any payments to partners in the form of remuneration, interest on capital. If you collect interest on drawings from the partner, that is also an appropriation item. Share of profits distributed to partner, amount transferred to reserves, all of these are appropriation of profits. This is done only if there is sufficient profits. If there is insufficient profits, you might choose not to make some payments. Got it? Then we need to understand what and all are the items and how will it appear in our P&L appropriation account. See, P&L appropriation is successor of P&L account. Once P&L account is closed and we have determined our current year profit, from that profit, we'll start appropriating it by preparation of P&L appropriation. If you imagine P&L appropriation account here, debit side, a credit side, your net profit comes down. In your trading account, GP comes on the debit side, it's brought down to P&L on the credit side. Similarly, in your P&L account, net profit is carried down from the debit side to the credit side of P&L appropriation. So in your P&L appropriation, on the credit, you'll have net profit. To this credit side, you'll write the items increasing the profit. Items increasing the profit is collection of interest on drawings from partners. And whatever payments are made to partners or transfers are made to reserves, that will come on the debit side. That will be interest on capital paid, salary to partners paid, share of profit paid to partners, or transfer to reserves. You'll write all of them. That's our debit items. Observe, remuneration to partners, interest on capital paid by the firm to the partner on the debit, and net profit brought down from P&L, received or collected by the firm from the partner will come on the credit. And ultimately, if there is any profit or loss, that will be shared to partners in their profit sharing ratio. There are some important points that you need to know among each of them. Remuneration to partners. I mentioned this to people yesterday also when we were doing final accounts. Whenever the remuneration needs to be paid to partners, gotta remember that it can be given as a fixed amount or it can be given as a percentage. Whenever the remuneration is given as a percentage of profit, then check, is it on before charging basis or is it on after charging basis. Whenever the statement uses the word before charging basis, we'll do profit multiplied by X divided by 100 for X percent. However, if it says X percent after charging basis, then we'll do into X divided by 100 plus X. That's one thing that you should remember when it comes to remuneration. Next point is interest on capital. See, whenever we're giving interest on capital, we'll pay interest on capital, which is, how to say, fixed capital. We are not going to give on current capital. We're not going to give on current capital balance. Now your question is, what is current capital? What is your current account? Like I mentioned about P&L appropriation account, we'd have to maintain capital balances of the partners. Capital balances are to be maintained under two methods. How many methods do we have? Two methods. One is fluctuating capital method. Other one is fixed capital method. One is fluctuating capital method. Other one is fixed capital method. Under fluctuating capital method, the capital balance won't be same. It keeps changing because everything is dumped into one ledger. Under fixed capital system, we open two ledgers. One for fixed capital account. Other one is current account. All the transactions which are happening because of partnership deed and mentioned in the partnership deed, like opening capital and additional capital, only they will come in your capital account. Everything else that is happening in the normal operations, profit, interest on drawings, interest on capital, salary, remuneration, commission, all of these kanji pinji payments will come in your current account. So that capital will remain same. The balance sheet capital and the fixed capital in your capital account will be the capital as per partnership deed. That is the capital on which we give interest on capital. But interest on capital is written in current account. So we split that same capital into two parts. Opening balance, closing balance only we write in one place. That is fixed capital account. All other transactions, share of profit, interest on capital, interest on drawing, salary, remuneration, commission, everything will write in one place. That is current account. Are you getting it? So if you prepare fluctuating capital account will look somewhat like this. Opening balance is on the credit. All the items increasing the capital of the partner on the credit side. All the items increasing the capital of the partner on the credit side. All the items decreasing the capital of the partner on the debit and the closing balance. For example, see, additional capital, increasing balance, credit side. Remuneration, interest on capital, interest on advance, increasing capital, credit side. Share of profit, credit side. Decreasing capital is drawings, interest on drawings and loss. Once we adjust this, we'll get the closing balance of the partner's capital. This is our partner's fluctuating capital system. If in case I choose to write this opening balance and closing balance in one ledger and write all of these items in another ledger, this another ledger where I write all of this regular recurring revenue items, that becomes current account. Place where I write opening and closing only and keep the capital as per partnership deed, that becomes our fixed capital. So this is fluctuating capital account and this is our fixed capital system, capital account. Capital account, opening, closing, additional capital. This additional capital, if it is as per partnership deed, we write. Otherwise, just like that, you got 10,000, it will come in current account. And this is our current account. Understood? Interest is given on this fixed capital account's closing balance, not on the current account's balance. Remember that. Then remuneration we are done, capital part you understood. Now interest on drawings. Whatever the money that is withdrawn by the partner, on that interest will be charged by the firm on the partner, and partner has to pay. He doesn't pay in cash, they'll cut his capital. If in case they have given that some amount of money is withdrawn by the partner, that drawings multiplied by the date on which you withdraw, from that date till the year end. The date on which you withdraw till the year end, interest will be computed. Let me repeat. drawings amount, thank you, drawings amount multiplied by period of drawings, the date of drawings till the year end, and then interest rate. When we apply that, what do we get? Interest on drawings. However, if the same amount is withdrawn at the beginning of every month, at the middle of every month, or at the end of every month, then what happens? For every transaction, we need to compute interest. No, first, second, third, fourth, every transaction, 12 transactions, 12 times in the beginning of 12 months. I need to compute it 12 times. It is irritating. Amount is same. Period is first transaction 12, second transaction 11, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Interest is also same. Principal amount is same. Interest amount is same. Period is decreasing. So what do we do? Period will take average. First number, last number divided by 2. Average period we get. For that average, for this amount, once we'll compute and we'll get the answer. That is called shortcut method. And that shortcut is done for this average period. I've given all the average periods at one place so that you don't have any trouble. Try and check this out. Remember, whenever the drawing is made at the beginning of every month, we'll compute interest on drawings for average period of how many months? 6.5. If the drawings is made in the middle of every month, 6 months. Come on, answer. In the end of every month. Okay. In the beginning of every quarter. In the middle of every quarter. In the end of every quarter. And they've done only once at the beginning of, half year, like 2 times a year they've done. Beginning of the year once, at the end of 6 months once. Then we'll do it for 9 months, average. What to do if the drawings is done on different dates? Several different dates. And it's not the same amount. Like, very drawing on 15th of April, 21st of May, 18th of June, 10th of July, 23rd of August, different dates, amounts are also different. Then we cannot apply shortcut like this. What should we do? We have to do product method. Either you can identify individually or you should do amount, period, product. It is basically P into T into R. Individually we should do each transaction amount multiplied by each transaction period multiplied by interest rate. But in that time and then rate, one thing is common. It is one transaction is 8 months, one transaction is 6 months, for one it is 3.5. What is common is divided by 12 and multiplied by rate. What is common? Divided by 12 multiplied by rate is common. So what I'll do is, first drawing is for 8 months, second drawing 6.5 months, third drawing 2 months. So I won't do each multiplied by 8.5 by 12 into 6% multiplied by 6 by 12 into 6%. I won't do that. I'll do into 8.5, into 6, into 3, into 2, into 1.5. I'll find the product. Total product. For once I'll do into 1 by 12 into 10, into percentage. So that's the shortcut. It is actually the same logic. It is the same logic. We'll just keep that divided by 12 and into percentage as common and we'll get the answer. And whenever they mention the drawings, one-time drawing, but they don't mention the date on which this drawing is made, remember to do it for a period of 6 months. Remember to do it for a period of and one important point is, whenever you do average, whenever you do average, you need to do total drawings multiplied by rate. You take average period, no. Amount should be total drawings. Total drawings means if it is monthly into 12 per month drawings into 12. If it is quarterly, per month, per quarter drawings into 4. So remember that, and that you don't forget. That is where people usually end up doing mistake, and rest is good. We can go to share of profit. Remember, share of profit will be distributed to partners after paying interest on capital, interest on drawings, salary, remuneration and all other payments that is supposed to be made. Before paying interest on capital, before paying interest on drawing, before paying salary, we cannot distribute profit. So first interest on capital, salary, commission, all other payments. After that, whatever is left out, no, that will be distributed among partners as share of profit. Do you get it? But there might become a circumstance where the profits are not sufficient to pay interest on capital. You have 10,000 rupees profit available. There is how much profit available? Interest on capital is more than 10,000. What to do in that case? Let me show you a case of that type. See, distribution of profits in the case of insufficiency. Observe the example. A and B are partners sharing profits equally. Capitals is how much? 2 lakh and 1 lakh. Interest on capital is 10,000, 10%. See, if interest on capital is 10%, A will get how much interest? 20. B will get how much interest? 10,000. Together, how much interest should firm pay? 30,000. But how much is the net profit available? From 15,000 net profit, can they pay 30,000 interest on capital? No. What is their profit sharing ratio? Equal. What do you do in this case? Profit should not be distributed in profit sharing ratio, because from the profit first you should pay interest on capital. Then what is left is the profit for appropriation among partners to be shared in profit sharing ratio. Because we don't have enough money to pay interest on capital, profit will now be shared in capital ratio. Profit will now be shared in. The logic behind this is we are actually not paying them profit, we are paying them interest on capital, but not in total, in proportion. ಸ್ವಲ್ಪನೇ ಇರೋದು ಸ್ವಲ್ಪನೇ ಕೊಡುತ್ತೆ, ಏನಿದೆಯೋ ಅದು ಕೊಡ್ತಾ ಇದೀವಿ. Got it? So see here, interest on capital 20 plus 10 30. Total interest on capital is how much? 30. As profit is insufficient to pay interest on capital, profit will be distributed in capital ratio instead of profit sharing ratio. Logic is they are paying proportion of interest on capital. How much is their capitals? 2 lakh and 1 lakh. So 2:1 ratio. So 2 by 3, 1 by 3. You pay 10 and 5. Profits 15,000 is not distributed as 7,500, 7,500. Profit is distributed as 10,000 and 5,000. Did you get this? Pakka. So this kind of tricky question can come. Be ready for it. Then this is minimum guarantee. A partner with minimum guarantee. So there are some special clauses using which you can say that a partner will get minimum this much amount of guaranteed money. Whenever they give question like this, there is slight amount of tricky thing, because of which even if we do some kind of an error approach, we will get answers in some circumstances, but not in all circumstances. I'll tell you where is it wrong. Now, let's take an example where Virat, AB and Nax are partners and they are expected to share profits equally. Nax is a guaranteed partner with minimum guaranteed amount of how much? 1 lakh. Now, let's quickly come to the last case. How much is the profit? 1,80,000. How much is the profit? Now, tell me, how do we share it between Virat, AB and Nax? 1,80,000. If you take from 1,80,000, first give 1 lakh to Nax and then take the balance amount and then share it between Virat and AB, you are doing it wrong. Don't do that. Always share the profit to all the partners in the profit sharing ratio. What is their profit sharing ratio? Equal. 1,80,000 will be shared between Virat, AB and Nax equally. 60, 60, 60. Now how much has Nax got? 60. Nax is a guaranteed partner. He has a minimum guarantee amount of 1 lakh. He has to receive 1 lakh. How much has he received? 60,000. To make it 1 lakh, he has to additionally receive 40,000. This 40,000 should either come from Virat and AB or only Virat or only AB. Depends upon who's the guaranteeing partner. Read the question. It says only Virat is guaranteeing partner. So it was 60, 60, 60. Nax, Virat, AB. From Virat 60, we'll eliminate 40 and give it to Nax. Nax will have 60 plus 40, 1 lakh. Virat will have 60 minus 40, 20. ABD will still have 60. Got it? So don't first give it to guaranteed partner. No. Share it to all the partners in profit sharing ratio. Then check whether guaranteed partner has got the guaranteed amount. If the guaranteed partner has not got the guaranteed amount, identify how much is the further amount to be paid. That amount, you take it from the capitals of guaranteeing partners in guaranteeing ratio. In what ratio? Guaranteeing ratio. Guaranteeing ratio need not be profit sharing ratio. That ratio can be different. Guaranteeing ratio can be different. Have a look at case 4 now. Now profit is 1 lakh. Sorry, profit is how much? 1,80,000. We'll share 1,80,000 between 3 partners. Virat 60, AB 60, Nax 60. How much is Nax minimum guarantee? 1 lakh. How much is Nax getting? 60. 60. We should give him additionally 40. This 40 should come from Virat and AB or Virat or AB. Depends who's the guaranteeing partner. Who's guaranteeing partner? Both. But it is not profit sharing ratio. What is the ratio? 1:2. 40,000 into 1 by 3. 16,667. No. 13,333. This will be contributed by Virat. 40,000 into 2 by 3. 26,667 will be contributed by AB. Got it? I'll show you how it works. First, take the profit, share it to, which case were we saying? Case 4, no? Yeah, first take the profit, share it to all the partners in profit sharing ratio. Then for the guaranteed partner, compare it with the guaranteed amount. He will get profit or guaranteed amount, whichever is less. Here he'll get the guaranteed amount 1 lakh. So he has to additionally get 40. This 40 has to come from the guaranteeing partners ABD and Virat in their what to say that guarantee ratio 1/3, 2/3. When you multiply and then deduct, you will get the correct answer. Do you get it? This is how you compute your profit sharing ratios. And by this, we are actually done with our introduction to partnership. There is nothing much, and little bit of problem practice is what's required. Let's quickly see if there is any question on this in our what to say RTP, and we will see and solve it if it's there. RTP partnership, incomplete records over. There is a question on dissolution of partnership. Partnership one basic question is there. Ex desire to retire. So we have only retirement question. Do we have anything before that? No. We have only retirement question. So we'll solve it when we see retirement. Okay. One thing that I want you to notice, this variety of question. So they'll give some rectification of error based questions in your partnership introduction. Let's say they've wrongly given interest at 12% to partners, but they were supposed to give 10% interest to partners. So what do you do in that case? Compute 12% interest. This is what is already given. This is what should be given. So for partner A, they've given interest at 12%, 1,80,000. At 10%, he was eligible for only 1,50,000. We paid 30,000 extra. You should take it back from him. When you have to take it back from him, his capital will reduce. So debit his capital account by 30. Similarly, partner B, interest given 360. Interest that should have been given 3 lakh. We have given 60,000 extra. Reverse it by debiting his capital account. Same with partner C. So we'll take the money back from them and then give it to P&L appropriation. There can be adjustment like this, or there can be adjustment relating to this one car based question. If you remember, there is one car adjustment. One car was forgotten to be recorded. It was wrongly recorded as an expense. I think that's slightly later. That's in admission or somewhere. But some rectification based errors also will come. So try and see and then give the impact to it. Remember that whenever there is an error rectification that happens, it will affect profit, which will affect capital of all the partners. And that has to be adjusted through the capital accounts of partners. Okay, fine. Can we get into admission of a partner now? Come on guys, let's start with admission of a partner. This is one of the examination question, December 2023. Do you want me to walk you through this question? One of the recent exam questions, December 2023, from partnership introduction. Shall we see this? Come on, let's see. December 2023 examination question. PQR are the three partners in partnership form. Company's partnership deed includes the following. R is entitled to get salary of how much? 10,000. P, Q and R to get interest at 6% on their respective capital of 2,50,000, 1,50,000 and 1 lakh. Give me a moment. Let me clear this. There we go. R is entitled to get salary of 10,000 per annum. Shall we give R salary? They've asked us to prepare P&L appropriation account. To begin with, we should start with net profit, what we don't know. When we know net profit, I'll write my net profit brought down here, which I don't know right now. Later when I get to know, I'll write. On the debit side, I'll write R's capital. How much is the salary that I'm paying to R? 10,000. It is decreasing our profit, appropriation of profit on the debit side. Then read the second adjustment. P, Q and R to get interest at what rate? 6% on their respective capital. 2,50,000, 1,50,000, 1 lakh. Now let me give interest on capital. That will reduce our profit. So I'll write here debit side to partner's capital. Interest on capital. Partner P, partner Q, partner R. 2,50,000 into 6%. 1,50,000 into 6%. 1 lakh into 6%. 2,50,000 to 1,50,000 and 1 lakh into 6%. 6,000, 9,000 and 15,000. Am I right? What is after interest on capital? R is to get extra benefit of 10% of profit in excess of 50,000 after providing for 1 and 2 above. So what should we take? We should take net profit. Net profit if it exceeds 50,000. Let's say net profit is 60,000. That additional 10,000 is there. No. In that 10,000 after paying these two items 1 and 2, if there is still something remaining, on that we'll get 10%. So this will compute later only. Right now we can't do. Actually, I can come to fifth adjustment or remake you read 3,50,000 and then, but we'll do later. But remember, what should we do? We should take the net profit. From that net profit, we should deduct 50,000. And we should deduct this 1 and 2. After we deduct 1 and 2, whatever comes on the 10%, we should give it to R. So to ensure that I don't forget this, here only I'll write here to R's capital account. Net profit minus R's salary minus interest on capital minus 50,000 into 10%. Is that right? I told no, to the extent net profit exceeds 50,000 and the first two items, we will give him 10%. Then next item, fourth one, Q is entitled to 10% of profit after providing all the amounts in para 1, 2 and 3 above. After doing 1, 2 and 3 above. So I'll write 2 Q's capital. This also I can't compute right now, later. But for Q, what will I do? Net profit minus 10,000 minus 15 minus 9 minus 6 and minus R's salary or whatever that R extra money. Then whatever is there on that, how much percentage? 10%. There is no 50,000 criteria here. So I'll do net profit minus R salary minus interest on capital minus R's additional remuneration. What we get into 10% is what Q's capital will be. Q will be given as additional remuneration. After that, last point, balance of profits and losses to be shared between partners in 5:3:2 ratio. So it is their profit sharing ratio. What is it? 5:3:2. Then start. Profit is 3,50,000. I'll write here net profit 3,50,000. Now, can I find this R's additional remuneration? 3,50,000 minus 10,000 minus 15 minus 9 minus 6 minus 50,000. What do we get? Multiply that with 10%. 20. 3,50,000 minus 10,000 minus 30 minus 50 into 10%. 26. Got it. Now, we similarly will find Q's remuneration. Q's remuneration is 3,50,000 minus 10 minus 15, 9, 6 minus 26 into 10%. That's it. Find our net profit to be shared to partners. 3,50,000. I'll write 3,50,000 here. Minus these items. 10, 15, 9, 6. Minus 26. Minus 28, 400. Five is to 3:2 ratio. Partner PQR. 5/10, 3/10, 2/10. 1,27,800, 76,680, 51,120. Got this? These items will appear in your partner's capital account exactly the same way. Whatever is written here, no, 2 partners capital, 2 partners capital. Here, salary of 10 to R, 10,000 to R. Then you gave 15, 9 and 6, no, to PQR. 15, 9 and 6. You gave them R additional remuneration 26, Q additional remuneration 28,400. 26 and 28,400. Then we have this share of profit to partners 127,800, 76,680, 51,120. Same to same. I'll write our opening capital and determine our closing capital balance. That's it. Easy. Can we now start with the admission of a partner? No difficulty, no, with this. Questions can become little tricky in partnership. Be careful. Expect slightly difficult questions. Don't expect it to be all easy. 10.2. Admission of a partner. Though we call it admission, in this discussion, we are going to majorly revolve around goodwill for good amount of time, which is in common for all the cases. So we'll discuss goodwill once for all for retirement and death also in here. And we'll discuss JLP after death of a partner. For all the cases, retirement and death together, I'll explain it to you after the concept of retirement and death of a partner. Then I think we can take a break around the time when we finish death of a partner, so that post break we can do dissolution of partnership and then start with company account. Cool. Come on. Let's start with admission of a partner. Come on. Admission of a partner. Why will the firm go for admission of a partner? Firm will go into admit a partner in order to increase their capital, increase the firm's managerial abilities, increase the scale of their operations, or open another geographical location में branch. These are the reasons. Whenever they do this, the perspective that we need to have is the person who is going to come in as a partner, he is buying a part of the business. He is buying right in every asset. He is buying right in every liability. Previously, that asset and liability belong to old partners. Now it will also belong to the incoming partner. So he will buy it and then become the partner. You need to remember that. Then, so he's buying a part of the business. That part is called as profit sharing ratio. Whenever you are selling something to someone, you should identify the value of it before you sell. So that is the reason we do revaluation. We have values, but these are old values. Now we're going to find the new values to see whether the old values and new values are same. If they are same, very good. If they are not same, to the extent there is increase in the value is profit that will belong to old partners. If there is decrease, to the extent there is decrease is the loss that should be borne by the old partners. So we do revaluation before we sell part of that asset or part of that liabilities. Once we revalue them, that profit is shared between partners. That is the reason we do revaluation account followed with capital adjustments. And in the process of revaluation, all the assets which are there in the balance sheet other than goodwill will be revalued at one place. Only goodwill will be revalued separately because of the complexity and the nature of the goodwill being different from the rest of the assets. And finally, after this, you will prepare a balance sheet position to check how will the firm look like after this admission of a partner. And that's the reason we do financial position, that is balance sheet after admission. Got it? So these are the steps, or this is the usual flow of problems in our partnership. To begin with, ratio based questions. So this can become tricky if we don't catch English very clearly. So they'll give old ratio, they'll tell what is the ratio that the new partner will get. You would have to compute the new partners ratios or new profit sharing ratio before we go forward. Whenever they don't mention anything, regarding sacrifice, they only mention the old ratio and they mention how much will the new partner get. Then always remember, their old ratio will become their sacrifice ratio. Their old ratio will become their, look at the question, Bhim and Chutki share profits in ratio 1:1. Raju comes for 1/3 share because they haven't mentioned anything. Bhim and Chutki contribute that 1/3 share what Raju will get in 1:1 ratio only. Because of which, after Raju's admission, if you compute new profit sharing ratio, in that Bhim and Chutki's ratio will be 1:1. Do you get it? So remember that whenever nothing is mentioned, old partners sacrifice in their old profit sharing ratio. And what do you do in this case? From the total firm share, you will deduct the Raju's 1/3 share. Whatever is left remaining, see Raju takes 1/3. What is left is 2/3. That 2/3 will be shared between Bhim and Chutki in 1:1 ratio. And this is how you deal when the question is given like this. Let's go to a different case. If you compute sacrifice ratio, you will still get 1:1 then. Got it? Now, let's go to a slightly different case where Bhim and Chutki are in partnership and their profits and losses are to be shared in what ratio? 2:3. Raju is admitted into the firm and Raju gets 1/6 from Bhim and 1/3 from Chutki. So here they've clearly mentioned how much will Bhim get individually, how much will Raju get individually from Bhim and Chutki. When they use the word from, F-R-O-M, deduct that fraction from the fraction of the share that the old partner has. Bhim has how much share? 2/5. Bhim has how much share? From 2/5, you deduct 1/6 to identify Bhim's new ratio. From 3/5 of Chutki's share, deduct 1/3 what belongs to Chutki to identify the ratio. See, we do 2/5 minus 1/6. Chutki, we do our 3/5 minus 1/3 what she gives. And then we find this 7/30 and 4/15 as their ratios. No, wait. 2/5 minus 1/6. Yeah, once I deduct it, what I find is the amount of sacrifice that they're trying to do. This is what we do when they use the word from. Remember, whenever they give the word from, deduct that fraction given after the word from the old partner's fraction. The third way of giving the question is they will not give the word from, they will give the word of. Whenever they give the word of, don't deduct this fraction before the word of from the old partner's ratio. Now 1/2 of Bhim, no? whenever they give 1 by 2 of beam, don't do beam share of 2 by 5 minus 1 by 2. That's wrong. It is 1 by 2 of 2 by 3. So you should first multiply this fraction with that fraction. The resulting fraction should be deducted. I repeat, whenever they don't mention anything, they just give new partners fraction. Old partners will continue to share profits between them in the same ratio. That itself will be their sacrifice ratio. Whenever they mention one fraction for the incoming partner and they use the word from, F-R-O-M, deduct that fraction from the old partner's fraction. If they use the word of, multiply and then deduct. Multiply with the old partner's fraction and then deduct it from the old partner's fraction to arrive at the new ratio. So that's what I can help you with in 2 minutes with regard to ratios. If I were to take, do it in detail, I would have to take more time. Do you want me to take one example, solve the question in detail, or is this sufficient? What do you do whenever they use the word from? Minus. When they use the word of, multiply and then minus. Very good. And that's the same thing that I've given here. See, from or of, you need to identify very clearly. From, then you would have to subtract. Of, then you would have to multiply and then deduct. Covers the entire scene. Then let's go to goodwill part. Other than goodwill part. Remember, revaluation means we are trying to sell the assets of the firm, which previously belonged to only old partners. Let's say A, B and C are partners. Assets belongs to A and B. Now when C comes in as a partner, C will become a partner, meaning C will also have right on the assets of the firm. Because C will also have right on the assets of the firm, partnership firm should sell that right what A and B has to C. So in order to sell, we need to do revaluation. In revaluation, if there is increase in the value of the asset, that is profit. If there is decrease in the value of the asset, that is loss. If there is increase in the value of the liability, that is loss. If there is decrease in the value of the liabilities, that is profit. So in revaluation, which is like our income and expenditure account, credit side will write incomes, debit side will write expenses. Credit side, income. Debit side, increase in asset, profit, credit. Decrease in asset, loss, debit. Increase in liability, loss, debit. Decrease in liability, profit, credit. Once we write all of this, we find balancing figure. That balancing figure will be shared to old partners in old profit sharing ratio. Let me repeat. Increase in assets or decrease in liability, credit side. Decrease in assets or increase in liability, debit side. We'll identify the balancing figure, share it to old partners in old profit sharing ratio. You get it? Whenever we do this revaluation, our capitals will change because of this. Our balance sheet assets and liabilities value will also change. These revalued figures will replace the original values, which is incorrect based on our cost concept, what we learned in chapter 1. We cannot be doing it. So whenever we do revaluation, value of assets and liabilities are changing. A firm can be of the belief system that we don't want to change our value of assets. Then what should they do? They should not do revaluation, but they want to share the profits, what they want. So what to do? You should do memorandum revaluation. What is memorandum revaluation? Same as revaluation, but we will reverse the revaluation adjustment. First, we'll write increase in asset, decrease in liability on the credit side. Decrease in asset and increase in liability on the debit side. Let's say you got profit. That profit will be shared to old partners in old profit sharing ratio. There you close your revaluation. You pull it slightly down to call it memorandum revaluation. In memorandum revaluation, what you do is, you will reverse what you done in revaluation. What do you do in memorandum revaluation? See, this is what you do in revaluation. I told you, credit side, increase in asset, decrease in liability. Debit side, decrease in asset, increase in liability. And ultimately we'll find profit or loss. Am I right? This will be reversed in memorandum revaluation. Memorandum revaluation, you do like this. Whatever increase in asset or decrease in liability you had written on the credit side, you will reverse it by writing in the debit side in memorandum revaluation. Same amount. Number 2, number 4. Blue color arrow mark shifted here. And decrease in asset and increase in liability, whatever you had written in the debit side in revaluation account, same will be reversed by writing it here. Whatever we had written on the debit side in revaluation will be shifted to credit side. Whatever was written in the credit side will be shifted to debit side. Then here we got profit that we had shared it to partners, that will be reversed here. Sir, then why are we doing it? The only point of difference is, here when we got profit, that profit was shared between old partners in old profit sharing ratio. I repeat, that profit was shared between old partners in old profit sharing ratio. On reversal here, we will share it to new partners in new profit sharing ratio. It will be shared between here old partners in old profit sharing ratio, here new partners in new profit sharing ratio. Ultimately, I will try to tell you what is happening here. Try and catch it if you can. The new partner who comes in will pay the share of profit to old partners without changing the capitals of without changing the balance sheet value of the assets and liabilities. Old partner should get profit. For that, they are changing the asset. New partner will say, you don't change the value of the asset in the balance sheet, or you don't change the value of liability. Your capital will increase. No, my capital will decrease for this. I will give you profit from my capital. I'll give you profit from. So the profit that should be given to old partners for revaluation will be taken from the new partner's capital. He will sacrifice. He will sacrifice because he is gaining in the future. He will give the money to the old partners. So that's the logic of memorandum. When do we have to do memorandum? We have to do memorandum when in the question they mention don't change the value of the assets, or they say value of the asset should be shown at the original values in balance sheet. What do they say? Show the assets and liabilities at the original values in balance sheet. If the question mentions this, then you have to do memorandum revaluation. You have to do. Got that? Very good. So this is the concept of memorandum revaluation. Then we'll understand the concept of goodwill in the case of admission. Shall we? Okay. One thing that's going to break your heart, make you feel little upset that everything that you understood is going to be shaky little here, is the concept of goodwill in the case of admission is not increasing. We always believe that new partner brings in goodwill, he doesn't bring in goodwill. He brings in money to buy goodwill from the firm. So whenever there is admission, goodwill doesn't increase. Goodwill will remain same. Whenever new partner comes in, goodwill doesn't increase. Goodwill will remain same. Initially, goodwill is shared between two old partners. Now the same goodwill will be shared between three partners. Are you getting it? Let us say this is the goodwill, what A and B have earned, and its value is 100. Now this belongs to A 50, B 50. Now C also came to the room, into the firm. Now this has to be shared between A, B and C. If A, B and C is sharing, A share will become 33.33. B share will become 33.33. C share will become 33.33. Now C's share should have been 0, no? He didn't sit and then he didn't put in any difficulty in making this, but he's sharing the benefit. So he should pay the money for the loss that A and B will face. A has share of 50, B has share of 50. Now A share is coming to 33.33, B share is coming to 33.33. A share is decreasing by 16.67. B share is decreasing by 16.67. Their share of goodwill is decreasing. That is compensated by C. C will buy 16.67 worth of goodwill from A. C will buy 16.67 worth of goodwill from B by paying cash to the firm, which will belong to A and B. So that's what is happening here. Here the goodwill is not increasing. When he brings in 33.33 rupees goodwill, he is not bringing goodwill, he is bringing cash. Why? He should buy goodwill from the other two partners. Got this? Pakka. Very good. Remember, goodwill will not increase on admission of a partner. What will happen? Goodwill of the firm is because of the efforts of old partners. New partner will enjoy the benefit of the goodwill in the future. So he will have to buy the goodwill from old partners. Like compensation paid for hard work of old partners for their loss of share in the future. In the future, whatever profits will earn, he is also getting equal share. But because of these people's hard work, so he'll compensate for the same. That's payment of goodwill. This payment, what the new partner makes, he can make in the form of cash. He can make in the form of non-cash consideration. He can bring in some other asset, or he can adjust it through capital. Can he skip? No. If he brings in cash, good. That cash, whatever he brings in, will write cash account debit to goodwill. Cash account debit to, for all of us who say goodwill will increase on admission, what is the journal entry? Cash account debit to goodwill. When you credit goodwill, goodwill is not increasing. It is decreasing in fact. But it will not decrease. He will buy goodwill. He will not take it home. He will leave it in the firm only. Then cash account debit to goodwill over. Goodwill account debit to old partners capital account in sacrifice ratio. So goodwill will get cancelled. Whatever cash he brings in will not go to his capital account. It will go to our capital account. That is goodwill brought in cash. If he brings goodwill in any other asset, whatever asset he brings in, that asset account debit to goodwill. That goodwill will be debited and credited to old partners in sacrifice ratio. If it doesn't bring goodwill in cash or in kind, then what do we do? Bidadilla. We will debit his capital account and credit our capital account. We will debit his capital account and credit our capital account. When we debit his capital will reduce. When we credit our capital will increase. Meaning money that he got in towards cash, no, towards business. In that only goodwill is there. And we both will take. So ultimately journal entry is whenever the new partner comes in and brings in goodwill, first journal entry, cash to goodwill. Then goodwill to old partners. In what ratio? Sacrifice ratio. If he brings in kind, whatever asset he brings, asset to goodwill, goodwill to old partners in sacrifice ratio. If he doesn't bring his capital account to our capital account, see, incoming partners capital account debit to sacrificing partners capital. Got it? Incoming partners capital account to the extent of the money he brings, or sacrificing partners capital account in sacrificing ratio. This can be done slightly differently, raising the full goodwill and writing off. You can write goodwill account debit and credit old partners capital account, and all partners capital account debit to goodwill. It is going to give same impact. It's going to give same impact as this. You get it? However, for problem solving on admission, retirement and death, you don't have to read these journal entries. You don't have to use these cases. I'll teach you one dabba, one box that you can draw. If you put in that box, everything gets adjusted through it. It is nothing great. It's not a great scientific invention. It is same thing what we're doing now. Sacrifice ratio, new ratio and everything. Written in the form of a box instead of doing it in the form of plus minus. And once you do that box, it will become very comfortable and soothing. We'll apply debit credit logic also there only. And that box result will be our journal entry. Okay. This is with regard to goodwill adjustment. You guys would have to learn a little bit on hidden goodwill also. I'll give you a question on hidden goodwill for you to solve. Come on, go ahead, solve this. I have a small acid reflex. So what will I do? I'll finish my glass of juice. Will you please do this question? I'll take a short break of 2 minutes. Meanwhile, you guys compute hidden goodwill in this case. Take 2 minutes. Let's see. So A and B are sharing profits equally and their capitals are 30 each. When C comes in for 1/3 share, we are asking C to bring in how much goodwill? So how much capital? 50. There's something wrong, no? See, equal partners. We have 30-30. We should ask him to get 30. We have asked him to got more. So what people usually do is, okay, should have got 30, he's got 50, 20,000 is goodwill. No. You should keep C's capital as base, not A and B's capital as base. If C's capital is 50,000 for 1/3 share, for 1/3 share if it is 50,000, what will be the total capital of the firm? 1,50,000. How? 50,000 into 3. If you cut the cake into 3 parts, one part value is 50,000. So total cake is how much parts? 3 parts. No, 50,000 into 3. 1,50,000 is the total capital of the firm. But what is the value that we see here? We see 30 and 30, A and B's value, 60 plus 50, what belongs to C. So capitals are right now like this, A 30, B 30, C is gotten 50. So 30, 30, 50, 1 lakh 10. So the hidden goodwill is 40,000. Did everyone get it? Please don't do 30,000 minus 50,000, 20,000 goodwill. No. Should keep C's capital as base to determine the goodwill, because he is the person who is newly coming. We have just identified how much capital should he contribute. Will you be able to do it if they give hidden goodwill questions of this type? Very good. Then all we would have to do is identify goodwill. Now we know how to treat goodwill. Once the goodwill is computed and it comes, what journal entry to pass, how to pass, that we know. But how do we value the goodwill? There are several methods to determine the value of goodwill. Several methods. One is average profit method. Average can be simple average or weighted average. Then there is capitalization, super profit, and annuity method. Under average profit method, how do we find goodwill? We'll take the average of the adjusted profits which are expected in the future, and that will multiply by number of years purchase. Why do we multiply by number of years purchase? Why purchase? Why not sale? Interesting, no? Number of years, adu profit again. That is the period for which we expect our customer to continue with us. So number of years purchase is number of years for which our customers will continue to come and purchase goods from us. If we say number of years purchase is 3, we mean to say for 3 more years our customers will come and buy goods from me. For 3 more years, if customers will come and purchase goods from us, for 3 more years we'll go on making sales. For 3 more years, if I'm going to make sales, for 3 more years I'm going to make profits. The profits that I'm going to earn in the next 3 years, physically the transaction has to happen after today. But right now I've earned that profit. It's like I run one shop wherein I sell goods of very high quality. People like my products, that for the next 3 years they'll buy goods from me only. That's my goodwill with number of years purchase 3. Meaning what? People will purchase goods from me for next 3 years, no matter what I do. So today someone wants me to sell my shop to them. If I sell my shop to them, they will earn next 3 years profits because of my goodwill, not because of their efforts. So I will sell my shop to them, ask them for all the assets that I have, plus 3 years profit. 3 years profit they should give me right now. Why? That is my goodwill. Next 3 years, whatever profit they make because of the customers purchasing the goods, it's because of me. It's because of the hard work, sweat and blood that I have put in the last few years. So I'll collect money from him for what? For the goods that I give, for the assets that I give, and 3 years profit that he will earn in the future. Got that? That is the reason we compute goodwill under average profit method as adjusted average profit multiplied by number of years purchase. Here we call it adjusted average profit. Okay, why adjusted? The profit that he should give me for 3 years. Why is he giving me for 3 years? Because in the future he will earn profit because of me. Am I right? How do we arrive at that profit? I'll take my P&L account profit. My recent P&L account profit I'll take. Recent is not the exact. I'll take last 3 years profits. I'll add and divide by 3. He's agreeing to it. Just before he agrees, he'll look at my P&L account and then say, what is this? Interest on loan. Interest from bank. What is this? Interest on investments. What is this? Loss. He's asking me all of these things. If there is interest on bank deposit or interest on investments. Now, interest on deposit is not because of goodwill. I agree. Customer will buy the goods from us because of our goodwill. Now, bank is giving me interest at 8%. Is it because of my goodwill? I have a greater charisma, so bank will give me 8%. Someone has TVS Excel, so for them they will not give 8%. Is it like that? No. Bank gives same interest to everyone. To me, to you, to Rahul Gandhi, everyone same interest rate. No mercy there. Are you getting it? So in our profit and loss account, when we take net profit for computing average, we should eliminate interest on investment. Or let us say in my P&L, there is some loss because of fire, 5,000 rupees. That loss won't happen every year. Loss won't happen. So we'll eliminate that loss and find net profit. So in P&L, there might be lot of items which are non-recurring or which are not operating or not regular items. Those items we need to eliminate. If it is expense previously deducted, we will add back. If it is income not included, if it is income wrongly included, we'll eliminate it. So all these adjustments we do know. After that adjustments, whatever profits we arrive for the last 3 years, 4 years or 5 years, we'll take average of that and multiply with number of years purchase. That is the logic behind the formula average profit method goodwill. How do we find goodwill under average profit method? Average profits multiplied by number of years purchase. Did you understand why do we do number of years purchase? And average profit should be adjusted for errors and non-recurring items. For errors and I received some lottery income of 1 lakh rupees which is there in my P&L. Will you receive every year? From that net profit, first eliminate that lottery income. Whatever balance you get, that you multiply by number of years purchase to arrive at the goodwill amount. Okay, very good. So after average profit method, then let's go to next method, super profit method. What is the next method? When do we apply super profit method? Super profit method's logic is actually very nice. It says that everyone earns profit. Every rupee of profit that you earn is not goodwill. Every rupee of profit that you earn is not goodwill. Bengaluru, wherever you put one dosa shop, people will come and eat dosa. You don't have to be very famous dosa shop. People will eat. People will eat. So everyone makes some 30,000, 40,000 per month by selling dosa. That is normal. Let's say everyone makes 30,000 by selling dosa. I made 60,000 rupees by selling dosa. Now, I made 30,000 rupees extra, no? That is a super event. That is because of goodwill. 30,000 everyone does. 30,000, if you keep the money idle in the bank, only bank will give interest. So to the extent that return everyone makes, no, that is called normal rate of return. What is it called? This normal rate of return is not because of goodwill. If I give you 1 lakh rupees, at the end of the year, you earn 10,000 rupees out of it. It's not anything great. Why? 10% any idiot in the market will do. You keep that money idle in the bank, you will get 8%. So let's say 8% is normal rate of return. Anybody with 1 lakh, they can make 8,000 rupees return. I made 12,000. 4,000 rupees I made extra over and above normal rate. That is super. That is super. How many years can I earn that super profit? Let's say I can earn it for 3 years. So 4,000 rupees, 1 year I can earn more than everybody. For 3 years if I multiply, 12,000 is my goodwill. So how do we do this? Very simple. Capital 1 lakh in our example. Multiplied by normal rate of return. Normally how much will everyone earn? 8%. 1 lakh into 8%. 8,000. This is normal profit. What is this? Actually I want 12,000. Actually I want from 12,000 I will deduct 8,000. 4,000 is super profit. How many years can I earn this super profit? 3 years. Multiply by 3, 12,000 is goodwill. I'll repeat. How do you find goodwill under super profit method? Don't start with goodwill formula. Start with super profit formula. To do super profit formula, you want actual profit. Sorry, you want normal profit. Normal profit. How do we find normal profit? Actual capital multiplied by normal rate of return. On the actual capital, if you apply normal rate of return, what do we get? Normal profit. That normal profit, you compare it with actual profit, you will get super profit. Super profit, you multiplied by number of years purchase, you will get goodwill. Observe, goodwill is equal to super profit multiplied by number of years purchase. Super profit is adjusted average profit minus normal profit. Normal profit is actual capital employed multiplied by normal rate of return. Shall we quickly see this example? See, profits is 1 lakh, 1 lakh 20 and 1 lakh 40. This is average. We can find average of this. Capital employed is 1 lakh, 10 lakh. 10 lakh into 6%, Madi. How much is 10 lakh into 6%? Normally everyone makes 60,000. What is our average profit? 1 lakh plus 1 lakh 20 plus 1 lakh 40 divided by 3. 1 lakh 20 is actual profit, actual adjusted profit. How much is this normal profit? Minus. What did you get? 61. That is super profit. That you multiplied by 2 years purchase. 1 lakh 20 is goodwill. See, goodwill 1 lakh 20, super profit 60, average profit 1 lakh 20. Normal profit is 60. Understood average profit method? Under average profit method, sorry, under super profit method, what did we do? We found differences between profits as super profit and then multiplied it with number of years purchase. Do you agree with me that this is better than average profit? This method is better than average profit. This doesn't consider full profit as goodwill. This only considers the extra profit that you earn as goodwill. Makes more sense. But the 2 years purchase is still debatable. How do you say 2 years purchase? How do you say 3 years purchase? It is an accounting estimate. So we'll replace that also. That's how we switch to capitalization method. Under capitalization method, what we do is, we have earned profit of 12,000. How much profit did we earn? In our example that I told previously, 1 lakh capital, 8% normal rate of return. We earned how much? 12,000. Am I right? If you earn 12,000, how much capital you should have put in to earn 12,000 rupees? Rate of interest in the market is 8%. No? Rate of interest in the market is 8%. No? Take 12,000 in the calculator, divide it by 8%. You get 1,50,000. How much do we get? If you want, you check 1,50,000 into 8% money. Hey, 12,000. You understood? So, to earn our 12,000 rupees at 8% interest, what is there in the market? You need to have capital of 1,50,000. But I am doing it with capital of 1 lakh. I am doing it with capital of 50,000. What I have not invested as capital, but I am still earning return on it, is my goodwill. 50,000. What I have not invested in the form of capital, but I am still earning profit, is my goodwill. How do we do it? We'll do it once again. How much is my profit? 12,000. How much is my profit? Normally in the market, rate of return is 8%. Divide my profit 12,000 by 8%. To earn the profit of 12,000, you need to, at 8%, you need to invest capital of 1,50,000. But the capital that I have invested is only 1 lakh. 50,000 worth of capital, what I have not invested, but I am still earning return on it, is goodwill. You got it? We'll check some different numbers. See, capital employed 80,000. Normal rate of return 6%. Average profit 6,000. To earn 6,000 rupees profit at 6%, how much capital should I invest? 6,000 divided by 6%. But how much capital have I invested? 20,000 is goodwill. 20,000 is? Are you running with common sense now? Don't mug up formulas. Mugging up formulas is the worst thing that you can ever do. You would have to run behind the logic. You would have to know the logic. Why is this multiplied by this, or why is this divided by this? What is this number of years purchase? What do you mean by NRR? And why are we applying it? Once you get the logic, no, you don't have to revise all of this the day before exam. You will still be able to crack it, go into the exam straight without revision of these items. Clear? Fantastic. So example 4 done. Then annuity method. Annuity method is where we identify the profits that will earn in the future, discount it to today's date, time value of money. After 1 year, I learn 40,000. After 2 years, I learn 60,000. After 3 years, I learn 85,000. After 4 years, I'll earn 1 lakh rupees. That is my profits in the future. No, I will discount it to today's date. I will discount it to today's date. When I discount it to today's date, present value I'll get of that future profits. That itself is our goodwill. So it is a present value of the future profits that I learn. So in short, what should you do? You should do super profit or adjusted profit multiplied by annuity factor. In QA, ma'am would have taught you how to compute time value. You get it? But accounts you don't have to work so hard. Why? Question paper they will only give annuity factor. Annuity factor 3.1240 multiply. Or they'll tell this year 0.909, 0.826, 0.751. You multiply, you will get it. So you don't have to work really hard. They'll give annuity factor, multiply it with the profits. Tamar, you got the goodwill. This is under annuity method. You got it? Say something. And after this, all you would have to do is go on preparing the ledger accounts for partners. And I told you, adjustments will be there in goodwill. So there will be some adjustments which you have to make. Non-recurring items or rectification of errors needs to be done. So that is the kind of questions that will be there here. See this here, these are the profits. These are the profits. These are the adjustments what we are doing. What is the adjustments? There is one repair expenditure that they've incurred, which has been wrongly treated as asset. Are you getting it? Or they incurred repair expense of 6,000, but they have not recorded it. Now we will record that. And because it has been not recorded as asset, now when you record it as asset, you should charge depreciation. Now when we charge depreciation, it will come like this. 6,000 rupees was incurred as repair. What did they do? Sorry, they bought an asset. What did they do? 6,000 rupees? Purchased an asset. They wrongly wrote it as expense, repair. Because they wrote expense of repair 6,000, profit would have gone down. But it is not expense. It is fixed asset. So what do? Increase our profit by 6,000. That is what we are doing in 2006. Now in 2006, if you don't call it repair expenditure, if you call it fixed assets, you will do depreciation. No? That is not charged. Why? Asset record madilla, depreciation ellinda madiritira. Would have not done. Now we should do depreciation. So we'll decrease depreciation 200 and 580. And They would have done some overvaluation of stock, undervaluation of stock. Let's say they overvalued the closing stock. What did they do? Yesterday we discussed in inventory. No, not yesterday. Day before yesterday. When you increase the value of closing stock, what will happen to profit? Increase. So in 2005, they've increased the value of closing stock, because of which profit has gone up by 2,400. Now we will reverse that profit. Extension of this is next year, because I told you previous year's closing stock will become this year's opening stock. Previous year closing stock was more because the profit was more. Now by rectification, we reduce the closing stock, profit will decrease minus 2,400. But because previous year closing stock was more, current year opening stock also will be more. When the current year opening stock is more, current year profit has become less. Now we are rectifying and decreasing our opening stock, because of which our profit will increase. So I will add 2,400. They have forgotten to write management charge of rupees 4,800 in every year. Write every year. Then you will find adjusted profit. See, we should not take this profits. Why? These profits doesn't have these many adjustments. Once you adjust this many, you will get this adjusted profits. Using this adjusted profits, you will apply weight and then find weighted average, because they have given weights. Once we find weighted average, we will multiply with number of years purchase to arrive at goodwill. So these are the kind of adjustments. These are the not exact things that we get in the exam. Insurance claim baratte, at asset treated wrongly will come. So a lot of these kind of adjustments will come, which you have to be ready for. Yeah, I hope you people will practice this. Will you? Same thing what I told. See, major repair expenditure was capitalized. Sorry, it is supposed to be capitalized. It is charged to revenue. And here I told no, closing stock was overvalued in 2005. Opening stock was overvalued in 2006. Same adjustments. If you practice it, it's going to be easy. Common sense step. You should know why do we add or why do we deduct. If you go on applying common sense, you don't have to mug it up. Okay, now we're done with introduction to accounting and goodwill adjustment. Now we'd have to do a proper question on admission of a partner. In our RTP, we have a question on retirement. So what I'll do is I'll give you overview of retirement, and then we straight away do the question on retirement. Is that fine with you all? Okay. How different is going to be retirement from admission of a partner? Very simple. In admission, a partner will come in. In retirement, a partner will go out. That's the difference. You would have to do revaluation, you would have to do partner's capital, you would have to do goodwill, you would have to do balance sheet. You will do everything. But only thing is, in the case of admission, before admission number of partners is less, after admission number of partners is more. In the case of retirement, before retirement number of partners is more, after retirement number of partners is less. In the case of admission, the partner who is newly coming in, he will buy his share in the firm, he will buy the assets of the firm, he will buy the liabilities of the firm, he will buy the goodwill of the firm by bringing money. In the case of retirement, that person is going out of the firm. He will sell his right in the assets of the firm. He'll sell his right in the liabilities of the firm. He'll sell his goodwill to the firm, and then he'll go. If he's selling, no, the continuing partners are buying. Continuing partners are ultimately one person will sell, one person will buy. Other than that, there is not going to be any much of a difference. Ratios will be slightly different. There are two important points that you should note with regard to ratios. Shall I tell those? Let's say A, B and C, Bhim, Chutki and Raju are partners 3:2:1. If they tell Raju retires because of old age and they don't give any other information, Bhim and Chutki will continue to share their profits in 3:2. Their old profit sharing ratio 3:2, new profit sharing ratio 3:2, their gain ratio also 3:2. So whenever a partner retires but they don't give any information, the continuing partners' old profit sharing ratio will be their new profit sharing ratio, that will be their gain ratio also. Sometimes they will give in the question, Tom, Jerry and Spike share profits and losses in the ratio 3:2:1. Tom retires and his share is taken by Jerry and Spike in the ratio 1:2. So here that person who's retiring, no, Tom, his share is shared by the continuing partners in 1:2 ratio. How much is Tom's share? 3/6. You do 3/6 into 1/3. 3/6 into 2/3. Whatever you get, that will be added to respective partner's share. Help me with this. What is Tom's share? 3/6. How much will Jerry get? 1/3. 3/6 into 1/3. 3/6 into 1/3. 1/6 is what Jerry will take. 3/6 into 2/3. 2/6 is what Spike will take. Jerry's share was 2/6. We'll add 1/6. It will become 3/6. Spike's share was 1/6. We'll add 2/6. It will become 3/6. So new profit sharing ratio is 1:1. Okay, am I going very fast? If you have to finish the entire syllabus in less than 10 hours or 12 hours, this is the speed at which I am supposed to go. I hope you people are comfortable. Okay. If not, mane go to YouTube ali 0.5x speed al nodi. Yeah, I can't slow down. So I expect you to say repeat whichever part you find slightly discomfort, you see it slowly. Okay. Did you understand this part? Then the next case, they can give a different ratio. Like just the ratio can be different, but retirement mein ratios will not become very complicated. Yeah, that's what I want you to note with regard to ratios. Then rest of it is all exactly like what we discussed in admission only. Yeah, now without wasting much time, but remember, the retiring partner will take his share and go. So he will sell his goodwill and continuing partners will buy his goodwill. Shall we do our RTP question on retirement of a partner? Come on, let's solve our RTP question. Nice question. There is JLP also in this. Shares put madam. Okay. Maybe if you want, we can plan a break after this question. After retirement. But still we'll have death, dissolution, then company account. It's okay. Company accounts will get over quick. Don't worry. On 31st of March 2023, balance sheet of X, Y and Z sharing profits and losses in the proportion to their capital stood as follows. They have given their balance sheet. On 1st April 2023, X desired to retire from the firm and remaining partners decided to carry on the business. It was agreed to revalue the assets and liabilities on that date on the following basis. I won't do revaluation account first and then do partners capital and then do balance sheet. I will run all three simultaneously. For that to happen, I want to have some presentation data ready. I will make it ready. If you want, you can join me. You can also prepare the table and everything, keep it ready so that we can start solving the problem together. Solution to question number 11. So we will start with revaluation account. So this is our revaluation account. After revaluation, I'll prepare partners capital account. And the partners capital account, what I'll prepare will have how many columns? How many partners are there? 8 partners are. Columns 3 partners. So I'll have 3 amount columns. I only count amount columns. So this will become our partners capital account. So partner X, partner Y, partner Z. Partners capital account ready. Then there we go, balance sheet. Do we need any other ledgers? I don't think we would need any. Cash, if there is requirement, we would do. They've asked us to do cash account. I'll now transform this to my balance sheet. My formats are ready. Can we start? Let's start. Come on, from the beginning. See, we'll quickly see what items have adjustment. Land, building, plant and machinery has some adjustment. Creditors has some adjustment. Debtors has some adjustment. JLP is there. Goodwill is there. And capitals will obviously change. And that's it. To begin with, capital X, Y, Z, 60, 90, 60. 60, 90 and 60. I'll write it in my partner's capital account as by balance brought down. How much opening? 60, 90, 60. If you have the habit of finishing revaluation and then doing partners capital, it will work in second PUC, where the number of adjustments are finite, number of adjustments are familiar. Looking at the question, you know what adjustments will come. It won't work in CA foundation. Please don't do it. You will get stuck. You might end up reading the question more than 2-3 times if you have to do one finish and then do the next one and then third. So please, request, don't do that. Sundry creditors of 30. Sundry creditors of 30 will come in balance sheet on the liability side. I'll write capital and then I'll give little space. I need to write no XYZ capital. So I'll write X, Y, Z. Who's no more going to be a partner? X is no more going to be a partner. So then Y and Z baratte. I'll write creditors. How much is our creditors? 30,000. I'll write in inner column. If there is adjustment, I'll write it post adjustment to outer column. If there is no adjustment, then I'll post that 30,000 same to outer column. So for now, I'll write 30,000 in inner column. Can I? What is after that 30? Land and building 90. There is some adjustment for sure. Isn't it there? So I'll write in my second. I need one additional column here. Can I take additional column so that I can do workings comfortably? Land and building 90,000. Then we have plant and machinery 60. I'll write this also in the inner column. What is the value of plant and machinery? 60,000. Stock also looks like there is some adjustment. Is there some adjustment for stock? Some revaluation is there for stock. So I'll write stock also in the inner column, 36,000. After stock in the balance sheet, we have sundry debtors 30,000. Sundry debtors also there is adjustment. What adjustment for sundry debtors? There is some provision. So I'll write sundry debtors also in the inner column, 33,000. Cash though, however, I won't write in balance sheet. Why? Cash balance is going to change. So I will write in my cash account on the debit side to balance brought down. How much? 21,000. Balance brought down 21,000 cash account. After I write cash account balance brought down 21,000, what do we have after that? We are done with our entire balance sheet asset side and liability side. Let's read adjustment one at a time. 1st of April 2023, X decided to retire from the firm and remaining partners decide to carry on the business. It was agreed to revalue the assets and liabilities as follows. Land and building are appreciated by 20%. Okay, this land and building is there, no? I'm going to do add revaluation at 20%. Let us do 20%. 90 into 20%. What do we get? 18,000. Oh God. So 18,000, and in the outer column what we would get then is 1,08,000. See here, asset account I debited. Asset account debit to revaluation account is the entry. It is profit. Here what we did is debit. Now I should do credit. In my revaluation account, I'll write here by land and building account. What is the amount? 90,000 into 20%. 18,000. Done. Next, plant and machinery to be depreciated by 30%. So plant and machinery value will decrease. Entry is revaluation account debit to plant and machinery. I'll write here less depreciation, or I can write revaluation only. At what percentage? 30%. If I do 30%, that would be minus 30%. 60 minus 18, it will give you 42,000. That minus 18, asset account is credited here. Debit will be revaluation. Can I say the journal entry is revaluation account debit to asset, revaluation account debit to plant and machinery? In plant and machinery, I have written by revaluation. Now, in revaluation account, I'll write to sorry. to plant and machinery. How much? It is going to be 30% of 16,000, which is 18,000. We're done. After this plant and machinery, what is the next item? Stock of goods to be valued at 30,000. We're going to value the stock of goods at 30. Let's see what is the value that we're going to give. It is right now at 36. They want to make it 30. If you want to make it 30, what should you do? Less revaluation. You should do less revaluation. How much less revaluation? Minus 6,000. We're going to do minus 6,000. Am I right? So that minus 6,000, what we're going to do? We're going to write it in revaluation account debit side because it is loss. Or in other ways, stock value is reducing. Stock credit. Debit will be. Very good. Stock account. How much? Then, old credit balances of sundry creditors 6,000 to be written back. Now, majority of them will get this adjustment wrong. I'm somehow very confident that you'll get it wrong. You tell me, what do I do with this 6,000 in my creditors? Return off means what will you do? Deduct. Return off means what will you do? Deduct. Return back means you should deduct. Return back means we should deduct. Return off is for debtors. Return back is for creditor. Return back doesn't means back haki add madi alla. Return back means deduction. Return back means what? Trust me, nambi nanna. So I'll write revaluation. Nange gottittu. Pakka idಕ್ಕೆ ತಪ್ಪು ಹೇಳ್ತೀರಾ ಅಂತ. Somehow very confident. So revaluation ಅಲ್ಲಿ we are going to write off. How much? Write back. How much are we going to write back? There is one question with this adjustment in our material also. 24,000 in the balance sheet. So now creditors value is decreasing. When the liability creditors is decreasing, creditors should be debited. Credit should be given to revaluation. So the entry is creditors account debit to revaluation. In revaluation account, we'll write by. Okay, how much? In other way, they're telling some old creditors are to be returned back. Meaning what? It is some old creditors. That person also doesn't know that he should receive money from you. So that liability is no longer there. You are going to reduce that liability. You are going to. So it's not going to be increase in liability. You are going to reduce that liability. So it is minus. Little difficult to digest, but write it on your hand if you want. Return back means minus from creditors. Tattoo ಹಾಕ್ಸ್ಕೊಳ್ಳಿ. ಇಲ್ಲಿ ಹಾಕ್ಸಿ. ಇಲ್ಲಿ ಹಿಂಗೆ. Creditors return back means deduct from creditors. Then provision for bad debts should be maintained at what percentage? 5%. Okay. Debtors is 33,000. I'm going to write here less. Provision for bad debts. At what rate? At 5%. Can I say it is 1,650? 1,650, whatever is provision here, no, it's a liability that you're creating. Sorry. 31,350. It's a liability that you're creating. So provision should be credited. Usually for creation of provision, I discussed this yesterday also in debtors, final accounts. What is the journal entry to create provision? P&L account debit to provision. P&L account debit to. Here we won't write P&L. Any profit or any loss arising in the process of revaluation will be routed through revaluation account. So it will be revaluation account debit to provision. What is the entry? Revaluation account debit to provision for bad debts account. How much is provision? 1,650. Got it? What is after this provision for bad debts? Joint life policy of the partners surrendered and the cash obtained 22,650. You surrendered the policy. You told we don't want policy anymore, and they gave you 22,650. In the balance sheet, do you have anything relating to JLP? No. So when nothing is there in the balance sheet, it means that JLP premium what they paid is treated as expense. So JLP surrender value what they get is to be treated as income. Let me repeat. What is joint life policy? Situation bandide. Shall I finish JLP? Now, if in case any partner dies, you have to pay the capital to the partner. In order to pay the capital to the partner, if you don't have money in the balance sheet, you might have to sell all the assets. It is not just the partner of the partner and kids of the partner and the parent of the partner that is dependent upon that partner. It is a partnership firm also which is dependent upon that partner. It is not just the relatives of the partner who will cry when the partner dies. Partnership firm, artificial person also will cry because it might die because of that partner's death. Death of a partner might become dissolution of partnership firm. Firm doesn't want that scenario. You die. Don't make me die. That is the reason they take insurance policy. It's like the earning person of the family dies. Rest of the people don't have the earning because that person who was earning is not there anymore. So now they also might choose to die. That shouldn't happen. That is the reason. If there is an earning person, get insurance claim done on that person. So if that person dies, let him die. You will get money. In the entire sadness that the person died, one happy news is that insurance claim bantu. Are you getting it? Yeah, one of my students once told long, he bought one Royal Enfield bike and then they had bought it in his father's name. So they bought the bike 2 months over and father died. It was among the entire thing that is there in the family, one thing that was happy is we didn't have to pay EMI because Papa died. They didn't have to pay EMI. Insurance claim got claimed and then that money got went for the bike and they didn't have to pay. Actually not funny. It was a very sad and emotional thing. Very nice student of mine. But just trying to keep the moment light because you are craving for break now. So did you understand this? So you pay insurance policy premium and then take the policy. Who's taking the policy here? Firm, not the partner. Who's taking the policy? Firm. Why? Firm is also interested. When the partner dies, the firm will receive the claim money. That doesn't belong to partners. That belongs to firm. When you say firm, that belongs to all the partners. It is not like A, B, C, 3 partners are there. C died. Usually C dies. C died. So when C dies, firm receives 1 lakh. That 1 lakh doesn't belong to C. That 1 lakh belongs to firm. All the partners will get share in that. C will also get share. A will also get, B will also get. Are you getting it? That whatever premium they pay, 2 options. One, you can write it as expense in P&L. If you write it as expense in P&L, full premium paid, you wrote as expense, full money what you receive from insurance company is profit. If you don't write amount paid as premium, you don't write the premium paid as expense, you write it in balance sheet asset side. You write it in balance sheet, that is like asset. Whenever the policy is surrendered means no one died, but you are saying you no longer want the policy and taking the money back from the insurance company. If someone dies, it's called claim. So if the person dies or if you surrender the policy, when you receive the money, that will be like sale of asset. Let us say surrender value what is there in the balance sheet is 10,000. Partner died and the firm received 1 lakh. Now 10,000 worth of asset is sold for 1 lakh, 90,000 is profit. So 90,000 will be shared to partners as profit. 1 lakh rupees will be received in cash. 10,000 value of asset will reduce. If you treat that premium as asset. If you treat that premium as expense, 10,000 paid will go to P&L. 1 lakh rupees received will come in cash and entire 1 lakh will be shared between partners. Why will you share entire 1 lakh? Previously when you paid 10,000 premium, you wrote 10,000 to P&L. That P&L lost 10,000 is borne by all the partners, no 10,000. Now 1 lakh what comes also will be shared by all the partners. When you wrote that premium as asset, 10,000 you didn't share it to all the partners as expense. You kept it in balance sheet. Now when 1 lakh comes, 10,000 adjust money, only 90,000 will be shared between partners. Simple terms. Premium paid if treated as expense. Policy money or surrender value received is income. If premium paid is treated as asset, policy money or surrender value received minus surrender value what is there in the balance sheet as asset. Balance will be profit, it will be shared. Any money received which is treated as profit will be shared between all the partners in profit sharing ratio and not just the deceased partner. Last point, if the partner dies, we get policy amount. If the partner doesn't die, partners, they would say, there is retirement and we surrender the policy, we'll get surrender value. Got it? Here, partner didn't die, retirement, we received surrender value, 22,650. There is 2 journal entries that will pass for this transaction. I'll write the journal entry here. Joint life policy. Joint life policy. I can straight away show it in the ledger, but I want you to know it with ease. I know that people find this irritating, so I am going to show the journal entry for this. Okay. Bank account debit. How much is received? Have they told received? Oh, so cash account, sorry. Cash account debit. How much is received? 22,650 will credit to JLP account. Sir, what will you do with this JLP, sir? We'll share it to all the partners. Okay. How? Profit sharing ratio. JLP account debit 22,650. It will be credited to partners. What are the names of the partners? X's capital account, Y's capital account, Z's capital account. How do we share it? 22,650 into percentage. Sorry, ratio. Have they given profit sharing ratio? Did we read in the beginning? Profits and sharing profits and losses. At the end, idya? Oh, proportionate alla hakbardri. Who told proportion? Nothing is mentioned. Starting ali idya? Future profits equally. Have they given loss in proportion to their capital? Because they mentioned, we're doing it. We won't assume it. 6 is to 9 is to 6. 2 is to 3 is to 2. 2 is to 3 is to 2. 2 is to 3 is to 2. 7 na? Three by 7. 2 by 7. Correct? One of them should get 1 rupee more. Beda. 6472. Okay. So the total will come to the same amount. Did you get this? Say something. Very good. Now, shall we post this to our respective ledger? So cash, do we have cash in balance sheet? No, now we'll write cash in balance sheet. Oh, we have opened cash account. In my cash account, I'll write here to JLP. How much? 22,650. And this will be shared between partners. I'll write by JLP. In our partners capital account, I'll write by JLP account. 6471. 6472 9707 9707 6472. Saryu, say something. What do we have after this JLP? Goodwill of the entire firm is valued at 42,000. X share of goodwill is adjusted in the accounts of Y and Z would share the future profits equally. Wow, goodwill account being raised. No goodwill account being raised. So without opening goodwill account, we'd have to adjust this. I'll tell you how to do this. ICA study material also, they've given similar adjustment, similar kind of, box they're drawing these days. So let's write X and we have Y. Let me tell you, this is not some super normal invention of mankind. This is the way the answer is given in ICA study material also. Okay, then first raising goodwill. We call it what? We will not literally pass journal entry for raising goodwill, but we'll assume that we have raised goodwill and then adjust it. So how much is the goodwill amount? 40. Okay, 42,000. This will be raised by crediting the partners in their old profit sharing ratio. So what will be the amount? 42,000 multiplied by 2 by 7. Am I right? Correct, Alvendri. 2 by 7 alva. Three by 7. 2 by 7. 3 by 7. 2 by 7. 12,000, 8,000 and 12,000 is actually 12,000 credit. Am I right? 18,000 credit. Sit. 12,000 credit. So this is the credits that we are giving to the partners. Now we should write off goodwill. Write off the same goodwill, 42,000, by debiting the partner's capital account. Am I right? How do we debit their capital account? The continuing partners in new profit sharing ratio. Who is retiring? X share will be adjusted between Y and Z in the future profits. Who would share profits equally. So Y and Z will share the profits equally. So we will do, I can write here, 42,000 multiplied by 1 by 2. 21,000 debit. See, they would have to give money, Y and Z, so their capitals will decrease, so it will be debited. 21,000 debit, 21,000 debit. Now we'll identify the net difference because of this transaction. So what is the net difference? X will get 12,000 credit. X will get 12,000 credit, meaning X will get X share. It should be given by Y. 18,000 credit, 21,000 debit. Which is more? Debit is more by 3,000. So can I say 3,000 debit? Which means that Y will contribute 3,000 towards X share of goodwill of 12,000. Because that is the proportion to which Y is gaining. Now, Z share is how much? 12,000 credit, 21,000 debit. Debit is more by how much? 9,000 debit. So Y will give 3,000, Z will give 9,000. Together X will get 12,000. Why? Because that is the ratio in which they are gaining. If you observe, what is the Y's profit sharing ratio? Old profit sharing ratio. 3 by 7. What is the Y's new profit sharing ratio? 1 by 2 minus 3 by 7. You solve this if you want. 1 by 2 minus 3 by 7. 2 and 7. Common multiple is 14. Am I right? 14 in 2 table. 7 times. Am I right? 7 by 14 or 7 minus 3 table, 7 table 14 is 2 times. 3 2s are 6. 7 minus 6 divided by 14. Or I'll remove all of this. Can I say is equal to 1 by 14? Pakka? Say something. Similarly, do it for Z. Z's old share is, Z's new share is 1 by 2. Correct? What is Z's old share? 2 by 7. So 14 is the denominator which is least common. So from 2 to arrive at 14, I should multiply it with 7. So 1 7s are 7 and 7 2s are 14. 2 2s are 4. 7 minus, can I say 3 by 14. So their gain ratio is 1:3. Artha aita? How much is X share of goodwill? 12,000. 12,000 you do it in 1 by 4, 3 by 4. 3,000 and X and Y should give the 12,000 in 3,000 and 9,000 because that is the ratio in which they are gaining. They are gaining in the sense they are taking over X share in that ratio. Did you all understand? Same thing we can do by identifying gain ratio, but table looks simpler to do. And you don't have to minus the ratios. Only thing that we're trying to do in the table is no magic. Only thing that we're trying to do is instead of deducting fractions, which is difficult, we'll multiply fractions with number and we'll deduct numbers. Here what did we try to do? First we deducted fractions, arrived at a resulting fraction. That fraction we multiplied with number. Deducting fractions is difficult. Multiplying fractions is easy. Deducting numbers is easy. So what do you do? Fractions you multiply with goodwill and then deduct the goodwill amounts to arrive at the, or to say who's sacrificing or who's gaining. That's easier to do. Clear? Yes, very good. So Y and Z I am going to debit 3,000 and 9,000. Y and Z. Y 3,000. Z 6,000. Why are we debiting this? Because they are going to give money to X. Sorry. I'll change. So Y and Z's capital will decrease by 3 and 9. And this is because of goodwill. and to this extent X capital will increase. I'll write here by Y and Z. You can write individually if you want, by Y account, by Z account. I would want to write it together one shot. You want me to write by Y's capital account, by Z's capital account? That is also okay. Understood this goodwill adjustment? What do we have after that? Is there any more adjustments? Yeah, total capital of the firm should be same as before retirement. Before retirement, how much was their capital? 60 plus 90 plus 60. Together how much? 60 plus 60, 120. 120 plus 90, 2,10,000. Here balance carried on also, they want it to be same. Yeah, 2,10,000. How did you get 2,10,000? 60,000 plus 90,000 plus, I can do one detailed working note, but I am trying to save time. Can I say it should be 2,10,000? That 2,10,000, X irodilla. X will return. Y and Z. In what ratio? Profit sharing ratio. They have told, see, in the profit sharing ratio. Profit sharing ratio is equal, no? So we'll do 2,10,000 into 1 by 2. So it should be how much? 1,05,000 for Y, 1,05,000 for Z. Am I right? 1,05,000 for Y and 1,05,000 for Z. Done. What do we have after that? Their profit sharing ratio. Amount due to Mr. X is to be settled on the following basis. 50% immediately on retirement, 50% in the balance within 1 year. So I am going to write here to cash account. 50%. And balance 50% I'll write to X loan account. This will be balance 50%. So I'll compute everything. Whatever balancing figure I'll get in X column, no. 50% I'll write to cash, 50% I'll write to loan. Whatever I write here to cash, in my cash account I'll write by X's loan. Sorry, by X's capital account. And balance amount what I should pay later, I'll write in my balance sheet as liability. X loan account. That will be the other 50%. And if the capitals are insufficient and cash is insufficient, continuing partners Y and Z should bring in so much money. Continuing partners Y and Z should bring in so much money. Got it? Now come on, see, ashte, question is over. Revaluation account, capital account and cash account along with balance sheet. Let's close things. Revaluation account, close revaluation. 24 and 25, 650. There is going to be loss. There's going to be loss. Am I right? What are the names of the partners? X, Y, Z. How much is the balancing figure? 1,650. 1,650 rupees. Share it between partners in 2 is to 3 is to 2. Two by 7, huh? What do we get? 4,7. Okay. Here also 471. 70. 707. 708. Sari hoita? Pakka? 471, 708 and 471. I'll write here to revaluation account. How much is revaluation? 407, 40, yaar 708, 471 re, 471 x, 708 and 407, 708, 471. Got it? So revaluation account is done. Partners capital. If there is any difference in Y and Z capital, they should bring in so much cash. There is no other option. They have to bring in so much cash. And X 50-50 will share. Shall we first finish X column? It was 78,471 minus 471. 78,000. 50% of 78,000. 35 plus 3. So 36,500. Sorry, 39,000. 39,000. Correct? 39,000 we are paying cash. Shall I write in cash account credit side? Come to our cash account. Excess capital 39,000. Another 39,000 we are yet to pay. That 39 will become liability in the balance sheet. 39,000 excess loan liability. Clear? We have an option. Instead of writing here cash as balancing figure, we can write Y's current account, Z's current account. If I write Y's current account and Z's current account, that means they have not got the money. If I write cash account, that means they've got so much money. Have they told that Y and Z to bring in sufficient cash to keep the capital in that ratio? So same before, individual capital in their profit sharing ratio. They have not told. If they say cash will be brought in, we would have written that. Now we have an option. We can do either. Cash per yana. Shall we assume that is bring in cash, or should I write the current account? Okay, by cash account. How much cash will Y bring in? 1,08,708 minus 90,000, this amount. So they are bringing 9,000 and 48,000 cash. 9,001 and 47,999 cash. Am I right? So let me write that in my cash account. To Y's capital account, to Z's capital account. 7,001 and what else? Sorry, 9,001. 47,999. And by this we are done. I have forgotten to write these capitals in my balance sheet. Let me write 1,05,000 and 1,05,000. Shall we write this 1,05,000 and 1,05,000 balance carried down cash, capital in the partners account? 1,05,000, 1,05,000. Together capital is 2,10,000. Did we finish capital of 2,10,000? So partners capital account is over. Now balance sheet has to be closed after closing our cash balance. Only thing left is cash balance. How much is the cash closing balance? Balance carried down. That is going to be 1,06,50 minus 39,000, which is 61,650. Let me write that in our balance sheet. In the balance sheet, on the asset side, we will write here cash. How much is it going to be? 61,650. 2,73,273 balance sheet will tally. I told you yesterday in NPO, I told you yesterday in incomplete records, I'll tell you today in partnership, any topic, the moment you follow double entry system and follow the pattern, it has to tally and there is no other option for it to not tally. Got it? Same applies even when you come to CA Inter, when you're preparing financial statements, when you're doing amalgamation, when you're doing internal reconstruction, when you do consolidation, when you do cash flow statement, every aspect. Always remember not to forget double entry system of accounting to always get sure shot success. By this, we are done with admission and retirement. Death will have a very quick overview. Take break and then death. Okay, we'll take a short break. And then it is 6:10. Shall we expect, can I expect you all back by 6:30? I don't want to give longer break because post break we have to do death, dissolution, then company accounts. Bonus issue, right issue, redemption of preferences and redemption of debentures. Small topics, but we don't want to keep them, for too long. I don't want to go till 9 o'clock. We want to finish ASAP and we can't extend for another day. I hope people know it. Yeah. So let's take a short break. Let's see you all in the back in the class at 6:30 p.m. Yeah. Take a break. Ready? Can we continue from where we left? Sure, please listen. Come on, guys. We have finished discussion of admission of a partner, retirement of a partner. Let's now move to death of a partner. JLP part also is done. Now we are discussing death of a partner. Death is very similar to retirement of a partner. The point of difference between death of a partner and retirement of a partner is death is not a planned event. Retirement is a planned event. You can tell a partner to retire. Hey, don't retire in the middle of the year, man. Retire at the end of the year. 31st of March, we'll close our accounts, then you retire. Someone is dying. You can't tell them, please don't die today. Wait till 31st of March. We'll close our financial year and then you die. You can't tell that. Or someone is like on the deathbed, but they didn't die. It is 31st of March. Like, please die today. Don't survive tomorrow. Like if you survive till tomorrow, then tomorrow New Year. Again, New Year accounts, you would have to do revaluation on 1st of April, middle of the year. Please don't die. Either die at the end of the year or don't die only. So you can't ask someone to do that. And in the case of retirement of a partner, you can negotiate terms. How many years of goodwill? How many years of purchase should we take for computation of goodwill? How much money do you want immediately? Okay, 50% will give immediately, 50% to loan account. You can debate, you can discuss, you can argue. All of this is possible in retirement. In death of a partner, once the partner is dead, you can't tell them how many years purchase. Show me in hand. No, okay, 0 years purchase. So goodwill is 0. How much money do you want immediately? Ask me. 10%, 20%. Paid, wow, okay, full money loan. So you can't do any negotiation with deceased partner. So deceased partner, in the case of death of a partner, we have to follow what is already pre-agreed in the partnership form. If nothing is agreed in the partnership form, then you can't make any new agreement with the deceased partner, but the agreement should be as per what is told in law or as per the terms which are favorable to the deceased partner's executor. Are you getting it? So when the partner dies, till the date of death, we have to give them interest on capital, share of profit, everything till the date on which the partner died. We would have to compute everything till that date and then give. However, in certain cases, the firm with a big heart says that even though the partner dies in the middle of the year, we are going to give them interest on capital till the end of the year, salary till end of the year, share of profit till the end of the year. Can the firm say that? Answer is yes. There are some questions where they are going to give interest on capital till the end of the year, salary till the end of the year. You can continue to give them. Or if not, you would have to disperse it immediately. Same, revaluation, profit or loss, salary, interest on capital, interest on drawing, everything should be adjusted, goodwill, share, everything, and then given to the deceased partner's executor. There is one important point that you need to note in the case of death of a partner, that is the profit needs to be computed on approximated basis. Profit is usually computed based on approximate basis till the date of death. We don't actually prepare P&L account on the date of death. That approximation can be either based on the proportionate turnover in the year till the date of death, or it can be based on the time. Proportionate means last year sales was 10 lakh, profit was 2 lakh. This year till the date of death, profit is sales is 5 lakh. So 50% of previous year's turnover is done, 50% of previous year's profit is expected to be current year profit. That is one way. Another way is time, number of months for which the partner was alive this year. Those many months into last year's profit, expected trend if any. If you do that, you will get the proportionate profit share. That is one way of computing the partner's death. One is turnover basis, second one is time basis. Did you hear me? Very good. Then the next point is with regard to section 37 of Partnership Act 1932. Whenever a partner dies, partnership firm deed should have told how to settle that partner's capital and the entire money to executor. If the partnership deed doesn't tell anything, and partnership firm should strike into an agreement with the executor of the deceased partner or the legal heir of the partner. If the partnership deed doesn't tell anything, you have not discussed or agreed upon anything with the executor, and you have not paid the money also. In that case, section 37 will apply. Section 37 says the deceased partner's legal heir will be eligible for interest on that amount available, interest on that amount payable at 6% per annum, or proportionate share in the profit, whichever is higher or whichever is beneficial to the deceased partner's executor. So the moment a partner dies, the firm has to pay the deceased partner's executor their share. If they cannot pay, they should agree upon an agreement with them. They should say, I will pay 50% now, I'll pay 50% after 1 year or after 2 years. Till then I'll pay 3% interest, 4% interest, or I'll pay entire money as loan, I'll convert and then I'll pay you after 2 years. We'd have to agree upon some agreement. If you don't make any agreement, and don't pay also, then Partnership Act 1932 says you are supposed to pay interest on that amount at 6% per annum, or you would have to pay proportionate share in the profit, assuming that entire amount payable as capital. Should identify how much of the profit belongs to that part of capital, that proportionate profit, whichever is beneficial to that retired partner's executor needs to be paid. Do you get this? Yes or no? This is one thing that people don't usually take seriously, but I want you all to read this and remember this. Section 37. Once you're done with this, rest of the retirement looks very similar to rest of the death looks like very similar to retirement. And now can we go to dissolution of partnership firm? Shall we? Dissolution of partnership firm. So whenever the firm dissolves, how do we deal with dissolution? One thing what you read in your second PUC is realization approach. Very similar to revaluation, but you don't just revalue here you sell them off. You sell your assets. That is realization approach. In realization approach, you transfer all the assets and liabilities of the firm to realization account. All the firm's assets and liabilities of the firm to realization account. In order to close the assets have to be credited, realization account has to be debited. In order to close the liabilities have to be debited, realization account has to be credited. Don't tell ikade. No. Assets have to be credited, realization account has to be debited. Liabilities have to be debited, realization account has to be credited. It's like packing everything into one box. Then you sell the assets and liabilities. When you sell assets, entry is cash account debit, not to assets. Cash account debit to realization. You need to pay off the liabilities. When you pay off the liabilities, entry is liabilities account debit to cash. No. Realization account debit to cash, because they are no longer assets and liabilities. They are all realization items now. When you do that, any balancing figure that comes in realization is our profit or loss. Don't try to identify profit on sale of each asset. No. Don't try to identify loss on settlement of each liability. No. Totally everything together will find one profit. That is realization profit. Like how we share revaluation profit, that will be shared to all the partners. You write capital to partners, you write realization profit to partners, close the partners capital account by paying them the balance of cash what is there in cash account. This is how we do our realization process. This is our actual realization accounting. Once the entire assets are sold, once the entire money is realized, what we do is accounting. But do you really think all the assets will be sold one shot? One asset will be sold, another asset you are waiting to sell, no one is willing to buy. With that money, do you keep that money with you just like that? No, you might start paying the liabilities. One on the liability will start paying. You might pay 1-2 liabilities. Still, next you will receive one more asset. Still 3-4 liabilities will be pending. So it's a long process. You will sell the asset, receive the money, pay liabilities, sell the asset, receive the money, pay liabilities, sell the asset, receive the money, pay liabilities. It will all happen in installments. So in the practical form, whenever this is completely happening, if you prepare the process in the form of a statement, that is what we call as piecemeal distribution. So piecemeal distribution is the practical part. Whenever the transactions are happening, as and when it is happening, you're keeping a record of it, piecemeal distribution. Once the entire dissolution is over, once you identify total sale value of assets, total settlement of liabilities, then if you write it all at one place, that becomes accounting under realization approach. Do you get this? This piecemeal we would have to do under two approaches. Two approaches are possible. One is highest relative surplus capital method. Other one is called maximum loss method. Both the methods are same. Just the way we approach both the methods are slightly different. You get it? Otherwise, both the methods are going to give you the same answer, and what we're going to do is exactly same. Answer will be same under either of the methods. Any problem that you give me, we can solve it under both methods. I'll pick up one problem and I'll solve it under both methods, and then I'll show it to you as to how does it work. Is that fine? Now, let's quickly see one realization approach question, and then we'll see one piecemeal distribution on maximum loss and highest relative surplus. Is that fine? What question do we have here? Seema, Meena and Tina. We have it, and they want us to apply maximum loss possible procedure. So they want us to apply which method? Maximum loss method. Shall I solve this question under maximum loss method as well as highest relative surplus capital method? Same question. Okay, this is our RTP question. We are doing much more than what they've asked. They've asked us to solve it under which method? Maximum loss. But we are going to solve it under which method? Highest relative surplus method and maximum loss method. I will first tell you just a small overview of how does this maximum loss and highest relative surplus method work. Shall I? Listen to me carefully. Remind me about Garner versus Murray at the end. I would have to explain Garner versus Murray once. Endly before we close this. See, how does say relative surplus method and maximum loss method work? Like I told you, it will all the transactions will happen simultaneously. Whenever you sell the asset and receive money, first you pay the money towards outside liabilities. After you pay outside liabilities, then you will pay partners liabilities. When you're paying partners liabilities, you pay partners loan first and then you pay partners capital. I'll repeat. When you're paying money, whom do you pay first? Outside liabilities. After you pay outside liabilities, you start paying partners liabilities. Among partners liabilities, first you will pay partners loan, then you will pay partners capital. Got that? Yes. See, first realization, then okay, ಇದು ಇರಲಿ. What I wanted to note as a difference between these two methods is partners capital. See, this is partners capital. Credit side, what is there is amount payable to partners. Out of this, some money we will pay. Balance of the money we can't pay. If you pay full money, all happy. But realization, you might not have money to pay all the liabilities. So, capital payable is here. Amount repaid is here. Amount that we are not able to pay is here. I'll repeat. Amount payable, amount paid, balance amount not paid. Under maximum loss method, what we are going to do now, what we'll do is, amount payable is there. From this, I'll identify realization loss and deduct this. Once I deduct this, I will get to know how much is to be paid. That is maximum loss method. Highest relative surplus capital method is amount payable is this much. I will identify how much amount should be paid and then find loss as balancing figure. Under highest relative surplus method, what is balancing figure? Amount payable is there. I will find how much amount will be paid. Balancing figure will be loss. Balancing figure will be, this is which method? Highest relative surplus capital method. Under maximum loss method, amount payable is there. We compute loss and then find amount paid to partners as balancing figure. Actually, one day ledger aliro more item. We find one and the other one is balancing figure. If you find the amount paid, it is highest relative surplus capital method. If you find the realization loss, it is maximum loss method. Did you understand this? Okay, now we are good. Now we'll do the question from our RTP. Ready for the question from RTP? Question number 12, correct? This is maximum loss method. Now I'll show you how to solve the same problem under highest relative surplus capital method also, and we'll get same answer under both methods. Now first we'll do maximum loss, whatever they're trying to tell. Whether you do maximum loss or you do highest relative surplus capital method, one thing which is common is first money will be paid to outsiders, then you will start paying partners. When you're paying partners, these two methods will come. When does these two methods come? When you're paying to partners, not when you're paying outsiders. So whether they ask maximum loss or they ask highest relative surplus, always do first table for payment to outsiders. Do first table to make payment to outsiders. Usually what students do is they draw maximum loss, amount payable, amount available, liabilities, partner A, partner B, partner C, you draw the column. Why? IC study material, they print like that. They print, you have to write. Printing, you can reduce the font size and then print in a paper. Writing, you can't do that. So don't try to mix all the columns in one table. Do one table only for outside liabilities. Once outside liabilities is over, then if you're doing highest relative surplus, separate way of presentation. If you're doing maximum loss, separate way of presentation. How many outside liabilities do we have? Trade creditors, loan from partners. So loan from partners is partner liability. It will be paid before paying capital, but after paying trade creditors. Am I right? So I'll write here. See, trade creditors is one liability, loan from partners is another liability. How much is trade creditors? 2,800. Loan from partners 1,400. Trade creditors 2,800. Loan from partners 1,400. Together I have two liabilities coming to 4,200 rupees. I have two liabilities coming to 4,200 rupees. Now, how much is the balance is 4,200. How much is the amount available? Do I have any cash? No, I have patent, furniture, machinery and stock. assets realized in full and in the order in which they are listed above. So what will I sell first? Patents. For what value? 1400. So I will sell patents 1400. I will not wait to sell furniture, machinery, stock and then start paying. Patents are sold. I will use the money that I realize from patent and then start paying liabilities. So let me write here sale of patents 1400. Sale of patents 1000. Now using 1400, can I pay trade creditors and loan to partners both? No. I should pay first trade creditors. So I'll write here less payment to trade creditors. 1400 amount available will become 0. And amount payable also will reduce by 1400 and I pay trade creditors 1400. After I pay this, my amount available has become 0. Balance is I would have to still pay 1400 to trade creditors, 1400 to loan from partners. Together I am supposed to pay 2800 rupees. Together I am supposed to pay 2800. Done. So first asset over, patents. Next I'll sell furniture for 2800. Shall I sell furniture? When I sell furniture, I got 2800 rupees. Now whom will I pay first using this? First I will pay my trade creditors. I'll write here trade creditors. I'll pay 1400 to trade creditors. That will become 0. I'm still left with 1400. That 1400 I will use to pay loan from partners. What will I pay? Loan from partners. So loan from partners. Do I have enough money? Yes. All right. Minus 1400. Minus 1400. Minus 1000. Minus 1400. This will become 0, 0, 0, 0. 0, 0, 0, 0. Amount available is 0. Amount payable to outsiders is 0. So this is over. From now, I will start with maximum loss method. However, I can do highest relative surplus also starting from here. Starting from here. Now I will do maximum loss method. So what will I do? How much am I supposed to pay Seema? How much am I supposed to pay Meena? How much am I supposed to pay Tina? 13,440, 8,400 and 11,760. 13,440, 8,400 and 11,760. Help me with this. Please tell me the total amount payable to partners. 21, 22, 32, 33, 33, 33,600 is payable. Amount available with me right now is 0 because whatever realized from patent and furniture, I paid it to trade creditors and loan from partners. I will sell my next asset, machinery. How much will I sell machinery for? 1,680. So let me write here machinery realized 1,680. When I sold machinery I got 1,680. I will pay 1,680 to my partners. Am I right? Whom do I pay? Should I pay Seema? Should I pay Meena? Should I pay Tina? I don't know. That's what I should figure out. That's what I should figure out. Which method am I doing? Maximum loss. Okay, just imagine. Seema, Meena, Tina. All three are sitting. Seema should receive 13,440. Meena should receive 8,400. Tina should receive 11,760. Together 33,600 rupees is required. We have only 1,680 rupees in hand. We are going to follow a very, very pessimistic approach. What approach? Andre, Seema, Meena, Tina, all of them are thinking 1,680 we have no by sale of machinery. Ashte. We will have no realization after this. We will not get even 1 rupee after this. This is the only realization. How much money do they want? 33,600. How much money did they get? How much money did they get? This is all imaginary calculation. They are assuming that only 1,680 is the amount available. If you pay full 1,680, we don't know to whom. We don't know to whom. That is what we are trying to find. We should know how much of 1,680 will be given to Seema, Meena, Tina. That we don't know. Let us assume 1,680 is the only money available. What will be the balance? 33,600 is there, no? Correct or not? Assuming that there is no further realization, only 1,680 is paid to all the three partners together. What is balance? H2 Allah. How much is the balance Allah? What is the balance money? Loss. What is the balance money? Correct? No. If they pay only 1,680, balance money is loss. 31,920. We don't know how should 1,680 should be shared between Seema, Meena and Tina. But we know how should this loss of 31,920 should be shared between Seema, Meena and Tina. We don't know how to share the money between partners, but we know how to share the loss. How to share the loss? Profit sharing ratio. How much is profit sharing ratio? See the question. 5:3:2. 5:3:2. Come on, let's share 31, 920 in 5 by 10, 3 by 10, 2 by 10 ratio. 15,960, 9,576, 6,384. We shared it. This much money they will not get. Now, if I do 13,440 minus 15,960, I will get how much money they will get? No. See, out of 13,440, what belongs to Seema? Seema will not receive 15,960. So minus 15,960. So much money she will receive. So much money she will. Logic karta hai tha. How much will she receive? 2,520. Correct? 8,400 alli. She won't receive 9,576. Minus madi. 1176. And 11,760 minus 6,384. 5,376. Here, two numbers are minus, one number is plus. You know what does that mean? Shall I tell? If in case 1,680 is the only realization, after this there is going to be no money to be realized. 31,920 will become realization loss. Expected realization loss. Actual or expected? Expected in our imagination. Why? There are still realization. There is still stock to be sold. But we are imagining that this is the last amount. 31,920 will become loss. If I share 31,920 to all the partners as realization loss, money that they should receive will come to this amount. You get this? When it comes to this, the logic here is Tina should receive 5,376. How much should Tina receive? Hey, realization itself is 1,680. How will Tina receive 5,376? For Tina to take 5,376, Seema should bring 2,520, Meena should bring 1,176, and Tina will take 5,376. Artha aita? How much cash is available? 1,680. Now I know what's running in your mind. Take your calculator. Do 1,680 plus 2,520 plus 1,176. 5,376 cash agata. Seema brings 2,520, Meena brings 1,176. Together it becomes 5,376. Full money Tina will take. This is how we share realization loss and then share. Till now, Seema, Meena and Tina are sitting. They're telling, okay, 1,680 is what we receive. Balance what we don't receive is our loss. If that is the loss, how much will each of us get? Tina should get 5,376. For Tina to get 5,376, cash available is only 1,680. Meena and Seema should bring in additional money. The moment Tina told Seema and Meena should bring 2,520 and 1,176 so that I can take home 5,376. Both of them are angry. They're jumping on Tina, hitting Tina and then pulling Tina's hair and everything. Girls fighting. Why? Imagination. What is it? This loss is imagination. This loss is, but just because the loss is imagination. In imagination, you cannot ask her to get money, no? In reality, you are asking her to get money for your imaginative loss. This loss of 31,920 is actually your imagination. Imagination. Is it truth? Is it actual loss? There is still further going to be realization. This is in our imagination. How can you ask her to get this much money? So later we'll say, okay, girls, don't fight. Please sit, relax. Then we'll tell, okay, fine. Tina, you won't get 5,376, but you will get full 1,680. Entire 1,680 should go to Tina only. Now Seema and Meena, okay, see, you take full money. I don't have a problem. But you ask me to get money? How fair is that? I should bring in money and you should take home the money that I get. No way. Do you really think Seema and Meena will get 2,520 and 1,176? They won't bring. They won't bring. So I'll make it 0. I'll do plus 2,520 plus 1,176. I'll do minus of how much? 2,520 plus 1,176. 3,600 and I'll minus so much. Do this 5,376 minus 3,696. See, Tina should receive 5,376. No. For Tina to receive 5,376, Meena and Seema should bring this money. Tina will tell, okay, you girls don't have to bring. Whatever you have to bring, I will sacrifice from whatever I have to take home. Now they're all hugging. Oh yeah, my best friend, like that. Okay. How much is 5,376 minus 3,696? 1,680. So this 1,680 should be paid to Tina. I told you maximum loss method is where From the amount payable, we will identify realization loss. And then we'll find amount to be paid as balancing figure. Here we determined realization loss and identified amount payable as balancing figure. Did you understand this? This what we did here is called as amount to be paid adjusted by way of surplus. Amount to be paid before adjustment of surplus. Here adjustment of surplus. This is the actual amount to be paid. So right now when we sold machinery, how much money did we get? 1680. That will be paid to whom? Tina. What is happening in black is reality. What is happening in blue is all imagination. But you are going to present the answer like this only. But in exam, you'll write everything in black. Blue color, sky blue color, pen ella el sigate. Now, tell me how much is the amount available. Amount available is 0. Amount payable is how much? See, 33,600 was supposed to be paid, no? How much did you pay in that? 1,680. Only black and black. 33,600 minus 1,680. 31,920. Did you get it? Here, 13,440. Did we pay anything to Seema? Same to same. Did we pay anything to Meena? Same to same. 11,760 minus 1,680. For just the purpose of checking, no, just check the total. 10,080 plus 8,400 plus 13,440. Do you get 31,920? Yes. Next, after machinery, what is the next realization? Stock. How much did you realize? 5,600. Let me write here stock realized. How much did stock realize? 5,600. How much did stock realize? 5,600. Did everyone understand that stock realized 5,600? Pakka. Now, again, pessimistic approach. What are we assuming? 5,600 realized, and after 5,600 there will be no realization. After 5,600 there will be no realization. And if there is no realization after this, then 5,600 will be paid. Am I right? Out of 31,920, what is supposed to be paid to all the partners, we will pay 5,600. How much to each partner? Adu gottilla. That's what we're trying to find. That will be balancing figure. Because we don't know whom to pay 5,600. But we know how to treat loss. Out of 31,920, what is supposed to be paid? If 5,600 is paid, how much will be not paid? 26,320. This is loss, no? This loss has to be shared between the partners in their profit sharing ratio 5:3:2. So do 26,320 into 5 by 10, 3 by 10, 2 by 10. 7,896 and 5,264. This much money will be not paid. This much money will be. So we know how much will be not paid. I told you in maximum loss method, from the amount payable, we compute how much the amount will be not paid. When we deduct what will be not paid, we'll arrive at amount that will be paid. Now 13,440 what belongs to Seema, 13,160 she won't receive. So how much will she actually receive? 280. Now Meena, 8,400 is what she should receive. In that 7,896 she won't receive. How much will she receive? 504. Out of 10,080 she won't receive 5,264. How much will she receive? 4,816. Do you understand? Take the total of all of this, you should get 5,600 because we don't have more than 5,600 to give. 5,600? Yes. Now, realization loss. See, we are supposed to pay 13,440. We paid 280. How much is the amount that we don't pay? 13,160. 8,400 we should pay to Meena. We paid her 504. How much will we not pay? Tina, we should pay 10,080. We won't pay 4,000. We pay 4,816. How much is the balance? That is lost. See, that is what we had computed here, no? If there is no further realization, how much will be lost? There is actually no further realization. So this is a loss that they will bear. This is how we do maximum loss method. I'll tell you the logic. Try and understand. Don't go by the format. Format mug-up madbedi. It won't work. Out of the amount payable, we will check how much money do we have. We will assume that this is the only money we have, and after this we won't get any money extra. So total payable say will deduct the amount available. Balance is loss. Share the loss to partners in profit sharing ratio. Balance what we get is the amount that will be paid. This is maximum loss method. Now you understood maximum loss method. Can I hope so? Go home and then solve the same question from your RTP. I will share this PDF to you people today only. Yeah, at the end I'll tell you where am I sharing. I'll share the Telegram channel where I'll share this. So you can download this from the Telegram channel at the end of the class. Watch the last 5 minutes of the video also. Yeah, after you watch Virat Kohli batting. So did you understand this table? Please try and solve this. This is the same pattern. I didn't invent a new method here. This is how it's presented in ICS study material also. I just try to put more logic into the same. Now usually whenever you do this piecemeal distribution problems, you do certain problems under maximum loss method. You do certain problems under IS relative surplus capital method. Do you do the same problem under both methods anytime? Usually you don't. How to get confidence in piecemeal? Do the same problem under maximum loss method and the same data, same problem under IS relative surplus capital method. Then you will understand how are both same but slightly different. Answer will be same under both methods. Now shall I solve the same question under IS relative surplus capital method? Ready? Okay, come on, let's see. So partners are there. This table is common. This first table is there, no payment of outside liabilities. This is common for both. Now we are going to write partners capitals. How much are we supposed to pay to Seema? 13,440. Meena 8,400. Tina 11,660. 11,760. These are capital. Now we have some money. Whom do we pay? Whom do we pay? Under maximum loss method, what do we do? We'll identify the loss first. Once we share the loss, balance will be the amount payable. Under IS relative surplus method, we should first find whom do we pay and how much do we pay. Now understand their profit sharing ratio. Now you cannot say Seema has paid more, I will pay Seema. You cannot say they will pay Seema. Why? Their profit sharing ratio is 5:3:2. 5:3:2. 5:3:2. Think like company. It is easier way. Think like company. 5 plus 3 plus 2 is what? 10. There are 10 shares in a partnership firm. How many shares are there? Seema has bought 5. Meena has bought 3. Tina has bought 2. And they've given 13,440, 8,400, 11,760. Let us see how much money have they paid for each share. For each share, how much did Seema pay? 13,440 divided by 5. Alva. How much did Meena pay? Okay. How much did Tina pay? For the same share, Tina has paid 5,880 rupees. Don't you think you should give money to Tina first? How much money should you give? How much our excess she has given, no? So much you should give. Excess means what? You should take someone's share and then minus, no? Difference. Whose share will you take? One who's paid the least. One who's paid the least. Who has paid the least per share? Seema. Seema, you paid very less. We will pay you at the end. We will pay you at the end. We will take Seema's capital as base. Seema's capital as base 2,688. If we take Seema's capital as base at 2,688 rupees, how much should have each shareholder given money? Now Seema has how many shares? 5 shares. So for one share, if it is 2,688, for 5 shares, how much is it? 2,688 into 5. 13,440. So basically Seema has not given anything extra. Has Seema given anything extra? Surplus idya? Illa. Seema has not given anything extra. If we take 2,688 per share as the value, for 3 shares, how much money should Meena give? 2,688 into 3. See, Meena should have given 8,064 rupees. But Meena has given 8,400 rupees. Meena should have given 8,064 rupees. Meena has given 8,400 rupees. Meena has given extra how much? 300 and that is surplus. So before we pay Seema, we should pay Meena 336. Because she's paid 336 more than Seema. Because she's paid 336 more than Tina is telling Samadhana. I am also there. I am also there. So what is Tina's share? 2 shares. 2,688 into 2. 5,376 what she should pay. How much has she paid? Papa. She's paid so much more, no? 11,760 minus 5,376. 6,384 she's paid extra. Are you getting it? See, this is everyone is in the same profit sharing ratio, no? This will be the last priority of payment. Third priority of payment is this. Last priority. Now, among Meena and Tina, they are kidding now. Who should get first? I should get. What do we do? Again, same thing we'll do. But we know that Meena should be paid 336, Tina should be paid 6,384 before we pay Seema. That much you know, no? Now, who should be paid first among Meena and Tina? We'll write ratio. What is the profit sharing ratio? 3 and 2. 3 and 2. For surplus, how much have they paid extra? 336 divided by 3. 112. 6,384 divided by 2. So, for that surplus share is there, no? Meena has paid 112 rupees per share. Tina has paid 3,192 per share. Who has paid more? Tina has paid more. Whom should we pay first? How much should we pay Tina first? How much our extra shares paid? How do we find? We find it taking 112 as base. If I take 112 as base, please do 112 into 3. 336. So this is the money Tina has paid extra. Meena has paid extra. How much was Tina supposed to pay that way? 112 multiplied by 2. 224. This is second priority. Equal in the ratio. Tina was supposed to pay 224. Tina has paid how much? 3,192. How much has Tina paid extra? Here 336 minus 336, it will be 0. 336 minus 336 here 0. Here how much? 6,160. 6,384 minus 224. Here it is 336 minus 336. If we know that this lady should not be paid anything, no? How does it become 0? 336 minus 336 alva. Illi 6384 minus 224 ಮಾಡಬೇಕಲ್ವಾ? 6,160 is first priority payment. This is called as absolute surplus. This is called as relative surplus. This is called as capital as per profit sharing ratio. This is the priority of payment. Whom should we pay first? How much? 6,160. After paying 6,160 to Tina, we should pay 336 to Meena, 224 to Tina. If that is also paid, then we'll pay all the partners. Are you getting it? Yes or no? Come on, let's see the distribution. How much is the amount payable to partners? 13,440, 8,400 and 11,760. See, here we found how much is to be paid. Now we'll find loss as balancing figure. There what did we do? We found how much is the loss, then found how much to be paid as balancing figure. There also when we arrived at this amount, here how much is the machinery realization? 1,680. Amount payable is 33,600. I did not know how to split this 1,680. So what did I do? I deducted 1,680 from 33,600 and I shared the loss to all the partners. Whatever I got, that I called as the amount to be paid. Here I won't do that. 1,680. First priority payment yarige? How much? 6,160. But I don't have 6,160. So what will I do? I'll pay entire 1,680 to, what is it? Tina. Let me write Tina. 1,680 fully paid to Tina. Got it? After this, balances. I'll write the balances. How much is the balance money? 10,080, 8,400, 13,440, 31,920. Here, I paid 1,680 to Tina. No, first. Come to maximum loss method. 1,680 paid to Tina. Here, I arrived at the loss and identified amount to be paid as balancing figure. There, I arrived at the amount to be paid and arrived at the loss as balancing figure. That's the difference. Okay. Here, see balance 10,080, 8,400 and 13,440. 10,080, 8,400, 13,440. Same to same. Next realization. You sold stock for what value? 5,600. This 5,600. Whom do you pay? First you should pay Tina 6,160. In 6,160, how much have you already paid? How much should you pay further now? 4,000? 4,480. So we'll pay 4,480 to Tina first in this. Did you understand how did I get this? It is 6,160. How did I get this? 6,160 minus 1,680. Now how much is remaining? From 5,600, if you pay 4,480, what is the amount remaining? 1,000. See, first priority payment is over. 1,100 something. Shall I pay this 336 and 224 now? 336 to whom? Seema. I'll pay relative surplus. 560, 336 and 224. Second priority. Okay. Still is there money remaining? How much? 5600 minus 4480 minus 560. 560. This will be used to pay. See, this is over now. These two payments are over. Now we'll come here. We should pay in 5:3:2 ratio. 5:3:2 ratio. Share this in the ratio 5:3:2. 5/10, 3/10, 2/10. 280, 168 and 112. See, now individually identify how much have we paid. 13,440 was supposed to be paid. We have paid 280. What is the balance? How much is the balance? 13,160. We were supposed to pay 8,400. We paid 336 and 168. Balance 7,896. We were supposed to pay 10,080. We paid 4,480, 224 and 112. Balance 5,264. Did you all get this? This is the realization loss. Together 26,320. Remember the numbers. 13,160, 7,896, 5,264. 13,160, 7,896, 5,264. Did you understand the concept that it is same? We get a sense of satisfaction when it matches with something, it tallies with something, it is equal to something. That is the reason you feel that sense of incompletion whenever you do this question and then you got some number, you don't know whether it is correct or not. So when you're practicing for the examination, don't do a separate IS relative surplus capital question, separate maximum loss question. Try and do the same question under both methods. Then the kind of satisfaction, completeness that you feel will be very different. Got it? This is IS relative surplus capital method and maximum. It's very logical, very practical. Yeah, you guys practice this and you will be able to ace it. One last thing that I wanted to tell is Garner versus Murray. This is what you would have not read in your second PE, but it's there in foundation. Now, Garner versus Murray is a case law. It happened long ago in England. So there were three partners. So Garner, Murray and then one more guy. So all three of them were doing business of cotton. And then suddenly one fine day what happened? The business went into loss. When the business went into loss, the firm was supposed to be closed. They did not have enough money to pay the liabilities. So partners were supposed to bring money. Partners were supposed to bring money. When partners were supposed to bring money, one of the partner had become insolvent. One of the partner had become, I'll show you. That partner who became insolvent did not have money to bring. His name is Wilkins. His name is Wilkins. So you will always hear about Garner Murray. No one will tell you about Wilkins. But actually the entire story is because of Wilkins. Yeah, it is because of him that the entire story and entire scene is happening. So you should know about Wilkins. Let me show. It's actually not here. It's in Inter. One moment. Inter Advanced Accounting. Old Advanced Accounting. Fast Track Revision. I can open here. Dissolution. Focus. Intro. ESOP. Payback. Amalgamation. Liquidation. Banking. NBFC. Consolidation. ಇದರಲ್ಲಿರುತ್ತೆ. Let me show. Piecemeal dissolution. This is my old CA foundation material. Sorry, old CA intermediate advanced accounting material. This is the case of Garner versus Murray. So we always know about Garner and Murray, but what we don't know here is there was another guy by name Wilkins. So Garner, Murray and Wilkins are three partners who are doing business, cotton business, long ago in England, 1900. That was the year in which they were doing. So then that cotton got spoiled because of wet, moist weather, because of which their business went into losses. And they were supposed to close their firm, dissolve their firm. When they were closing or dissolving their firm, they didn't have to have enough money to pay the liabilities. So liability of the partners, unlimited liability, partnership firm. It can extend to the personal assets of the partnership firms, partners. So partners had to bring in money. What happened is this guy Wilkins became insolvent, meaning he told, if I sell my private assets, I don't have enough money to pay the liability. So then Garner and Murray should bring in money. Am I right? 3 partners are there. One partner doesn't bring. Other 2 partners should be standing by each other and then bring. No. Then Murray told, I will not pay. Why? He told, my capital account has debit balance. My capital account has, but I have money personally. Personal assets are there. He is solvent, but his capital account has debit balance. So he told he won't pay money. Garner told, so what? Then partners, no, they kept dissolution aside and liability settlement aside. They went to court of law. Justice Joey studied the entire case. He told, whenever a partner becomes insolvent, how much ever money he can bring, so much you collect. Whatever money he cannot bring will be borne by the solvent partners with credit balance in their capital account only. What did he tell? Credit balance in their capital account only. If any partner has debit balance in capital account, then that partner is not liable. Then that partner is not liable for the insolvency of another partner. He further went on to told that if in case there is realization loss, first all the partners who have realization loss, every partner should bring in their realization loss in cash. They should bring their realization loss in cash, because realization is not possible without payment. So we'll reverse the realization by bringing in cash. Then identify the deficiency in the insolvent partner. Insolvent partner also can bring some part of the money. Let's say realization loss for Wilkins is 10,000. He is able to realize 40%. So he'll bring 4,000. 6,000 is lost. No, that 6,000 should be shared between Murray and Garner, provided they have credit balance in their capital account. What if one of the partner has credit balance or debit balance, negative balance in capital account? Only the partner with credit balance will bear it. What if both of them have credit balance? They both will share it in the ratio of capital, not in profit sharing ratio. They both will share it in the ratio of capital outstanding just before dissolution. Just before you give this impact of dissolution, how much our capital is there, that capital ratio they should share. Did you get this? This is what you should know when it comes to Garner versus Murray. So there are questions on Garner versus Murray in your material. With this knowledge and understanding, you just see those questions, you will be able to crack it, or I'm hoping that you will be able to crack it. If in case you get stuck, then let's see, whenever we meet next time, please do ask, or I'll try to see how else can I help you people on this topic. I will show Garner versus Murray. See here. Whatever I told you is here. Insufficiency of the firm. When the partners, when the realization from assets is insufficient to pay liabilities, then the partners are liable to pay, bringing additional capital from their private estate. They should bring money from their pocket and from home. So unless it is unlimited liability, unless it is LLP, where there is no unlimited liability. Now, when all the partners are solvent, all the partners will bring and then pay, no problem. When partners are insolvent, that is all the partners are insolvent, then there is no money, you won't pay. Some of the partners are solvent, some of the partners are insolvent. Who will bring, how will they bring is what Garner versus Murray will tell. Okay. When all the partners are insolvent, then nothing to do. Transfer everything to deficiency account. Where do we transfer? Deficiency account. Insolvent means nobody has money to bring. So much money will not be paid to outsiders. So much money will be called deficiency. Deficiency is treated like profit and shared to partners credit side. It is like profit, but not profit. It is like they don't have to bring money because they cannot pay liability anymore. Second one, I'll straight away come to Garner versus Murray. Like I told you, step 1, what should we do? Recover realization loss from solvent partners. Whoever can bring money, how much ever they can bring, they'll bring money. After that, we'll identify the deficiency of the insolvent partner. He's called insolvent because he cannot bring money. Such insolvency of the such deficiency of the insolvent partner will be borne by the solvent partners with the credit balance in their capital account, in capital ratio. I'll repeat, deficiency of the insolvent partners will be borne by the partners with solvent partners with the credit balance in their capital account. See, deficiency of insolvent partner will be borne by solvent partners with the credit balance in capital account. In what ratio? Capital ratio. If you have fixed capital, that fixed capital ratio. If you have fluctuating capital, then capital just before dissolution entries. Just before you make any adjustment for dissolution, whatever is the capital, that ratio will take. Are you getting it? Yes or no? Very good. There are a lot of questions on this topic in your material. Please do try. Yeah. And now can I go to company accounts finally? Cool. Let's start with company accounts. And you want a short break of 5 minutes? Okay. Enjoy a short break of 5 minutes. I will start with company accounts on the other side. We will not spend too much time on issue, forfeiture, reissue. We will straight away zip to our bonus issue, right issue, redemption of preference shares and redemption of debentures. We'll do the question that is there in our RTP. Don't worry. It's a nice question on debentures. We'll do it. I think we'll do study material question. Study material, some illustration number 2 he made me do the other day. It was nice question. I don't know. Short break. 5 minutes. There we go. Let's start with company accounts. Chapter 11 of our syllabus, the last topic, but it has several units. The initial part, whatever is relating to introduction to company accounts or issue, forfeiture, reissue, and debentures issue. So that's the easy part, what you're comfortable. We'll go slightly quicker so that we get time in bonus issue, right issue, redemption of preference shares and redemption of debentures. So to begin with, company, whenever it wants to raise money, it can raise money by way 2 ways. One by way of shares, other by way of debentures. Whenever it raises money by way of shares, it can be equity or preference share. How do they collect money in terms of shares? 3 stages: application stage, allotment stage, call stages. These are the 3 stages in which company can collect the money. So in the key event of application, first the money is collected, then it is transferred to capital. In the event of allotment and call, first the transfer is made to capital, then the money is collected. I'll repeat this, note it. First the money is collected on application, then it is transferred to capital. However, in the event of allotment and call, first the money is transferred to share capital and then the money is collected. That is the reason the journal entry will be bank account debit to share application account debit to share capital. Imagine this is our share application, share allotment, share call. There is bank here, there is capital here. What is here? Bank. What is here? Capital. Here application, allotment, call. So bank account debit to share application account debit to share capital. With regard to allotment, share allotment account debit to share capital, bank account debit to share allotment. And at call stage, share call account debit to share capital, then bank account debit to share call. Did you understand this? That's the flow of things in the entries. And if in case the number of applications received is more than the number of applications that we called for, it will become oversubscription. To the extent shares are allotted, very good. Excess money collected will be transferred to calls in advance. You get it? In the case if we don't receive the number of applications that we called for, it will become under subscription. If there is minimum 90% subscription, company can go ahead with the issue. If not, they need to reject the applications and refund the money. Further, that applications which were received in excess, more than what we called for, I told you it will be transferred to calls in advance. As a company, to me it's a liability because I have money with me which I have not called for. Because it's a liability to me, on that liability I pay interest to my shareholders. So interest will be paid by company on calls in advance at a higher rate, 12%. If in case I ask for money from the shareholder but the shareholder doesn't pay, it will become calls in arrears. What does it become? On that calls in arrears, company will collect interest from the shareholder. So on calls in advance, company pays interest. On calls in arrears, company collects interest. When the company is paying interest on calls in advance, company pays interest at 12%. When the company is collecting interest, company will collect it at 10%. Calls in advance pay, whatever interest that the company pays is expense. And calls in arrears, whatever interest the company will collect is its income. Did you understand this? See, interest is expense on calls in advance, interest account debit to cash. Interest is income on calls in arrears, cash account debit to interest. And later it will get transferred to P&L account. 12 and 10%. Remember the percentages. Done. Sometimes the excess money collected in application will be adjusted with allotment only. Sometimes allotment and it will be carried forward to call stage also. So you just need to do a proper working note before you do the problems. I can't do that problem on journal entry, but all I would have to tell you or all I want you to remember is whenever the questions are simple, it's okay. Whenever the questions become more and more complex, there is one shareholder who doesn't pay the money on application, one shareholder who pays excess money on application, one shareholder failed to pay first call money, one more shareholder failed to pay second call money. Whenever these kind of questions come, don't try to hit the journal entry straight. I'll show one of the questions to you. you would have to always start with a detailed working note. See, detailed working note. You do a proper table like how you do in depreciation. This shareholder, how much did he pay? How much was he supposed to pay? How much excess has he paid? How much shortage has he paid? This shareholder, how much was he supposed to pay? How much has he paid? How much has he paid extra? Or how much has he paid shortage? When will he pay? So do this kind of separate column for each shareholder and you will find it very comfortable to pass journal entries. Yes, doing this table will take time, but you will save the same amount of time when passing journal entries when you have the working note ready with the total amounts there. Got it? So shall I skip this part and not do a problem on this? Very good. Then I'll run you through forfeiture. What do you mean by forfeiture? When there is calls in arrears, meaning a shareholder has to pay money but he hasn't paid money, you will wait to collect. You will wait to collect. You will wait to collect. You will call him and ask him. You will warn him and ask him. If he doesn't pay, finally what do? Cut the share that he has. Cancel the share that he has. Whatever the share that he has with him, you will cancel that share. It means it's no more a share. That is what we call forfeiture. When does a company do forfeiture of share? Whenever there is calls in arrears. Whenever there is. So we take the share back from him. We take the share back from him. Do we give the money that he has given? That will become our profit. Temporarily profit. Unless we make loss on fresh issue. So the share, when it is increasing, we credit it. When we take the share back from him, I will debit because my capital is decreasing. On forfeiture, I will debit share capital. On forfeiture, I will debit share capital. Before forfeiture, there was calls in arrears, meaning he has to pay me money. Now when I forfeit the share, will I still ask money? If I keep the share with him and ask money, he will pay money or he will at least listen. I snatch the share also back from him. If I ask money also, then he won't tolerate. So what do? Previously we had calls in arrears as asset. Now that asset is no longer there. So we debit share capital account, we credit calls in arrears. We debit share capital account and we credit calls in arrears. That asset will no longer be there. But some money what we had collected, what will happen? That will go to temporarily share forfeiture account. So the journal entry on share forfeiture is share capital account debit to calls and arrears to share forfeiture. That balance in share forfeiture here is representing the money that we collected but we didn't return. Money that we collected that we didn't return. This can become our profit but it is not yet profit. This can become our profit but this is not yet our profit. Let's say the share is of 10 rupees. He has paid 8 rupees. He didn't pay 2 rupees. So I snatched the share from him. He has paid 8 rupees. He did not pay 2 rupees. Called up is 10. Unpaid is 2. Paid up is 8. Now, I won't keep that share with me. I will reissue the share. On issue of share, par and premium is allowed. Discount is not allowed. On reissue of share, par, premium and discount on a condition is allowed. Discount on a condition is allowed. What is it? It will be like, for the face of it, it should look like discount, but actually it should be not discount. That means what? See, old shareholder paid me 8 rupees. He did not pay me 2 rupees. Now, I can issue it at a discount of 8 rupees. I can issue it at a discount up to 8 rupees. Why? If I reissue a discount of 8, I'll collect 2 rupees. New shareholder paid 8. New shareholder paid 2. Old shareholder paid 8. Together I have collected 10 rupees. I am happy. Can I reissue a discount of 9 rupees? No. Why? Maximum discount is limited to the amount collected from old shareholder. How much did I collect from old shareholder? So maximum discount that I can give is, why is it so? I'll tell you the reason. Let us say I issue a discount of 9. If I give it a discount of 9, the new shareholder will give me 1 rupee. Old shareholder has given me 8 rupees. 8 plus 1 together. Nominal value. Nominal value is 10, but I collected only 9. That is not allowed. So I should ensure that on the whole, the issue is not a discount. I've collected the nominal value. On the whole, there is no discount. Do you get it? In short, you can either tell it as maximum discount allowed is limited to amount collected from the old shareholder. Or to ensure that money collected from the new shareholder plus the money collected from the old shareholder together should be minimum nominal value. Are you getting it? Yes or no? Let's say the old shareholder paid 8. New shareholder, I am issuing it at 3 rupees. I collected 3 from new, 8 from old. Together, how much have I collected? 11. Nominal value, 10. 1 rupee that I have collected extra will become profit, not premium. It will become profit, not premium. It will go to capital reserve. I'll repeat. Old shareholder paid how much? 8. New shareholder paid how much? 3. 8 plus 3, 11. Nominal value, profit. Let's say new shareholder paid 5. Old shareholder paid 8. 8 plus 5, 13. Nominal value. 3 rupees extra collected. Profit. Sir, when is it premium? I'll tell. New shareholder. You reissued at rupees 11. To new shareholder, you reissued at rupees. Nominal value is 10. You reissued at 11. 1 rupee premium. How much profit? 11 rupees only, 1 rupee premium. Balance collected is 10. Old shareholder paid 8. 8 plus 10, 18. Nominal value 10. 8 rupees profit. Did you understand? When is it premium? When the issue price is more than nominal value, it is premium. When the issue price is more than nominal value, it is. When the issue price is not more than nominal, there is no premium. There can be profit, but there won't be premium. So to do this, we do some small questions. See this in example scenarios. In this scenario, how much is profit? Is reissue allowed? Reissue not allowed? How much is profit? How much is premium and everything? So if you see this, you will get a fair idea. Then we were discussing beyond that discount is not allowed. And on the reissue, whenever there is discount, it will be debited to share forfeiture. Because I told you, I'm giving discount to the new shareholder only because my old shareholder had paid me money. So I'll adjust it with share forfeiture. Balance in share forfeiture will be transferred to capital reserve only if the share is reissued. Only if the share is, if the share is not reissued, we will not transfer it to capital reserve. Got it? This is with regard to issue, reissue, forfeiture. Can I now quickly go to the next topic? Next topic is bonus issue and right issue. Bonus issue and what do you mean by bonus issue? What do you mean by right issue? Bonus issue is free share. What is bonus issue? Bonus issue is free share given to the existing shareholder. The other way of seeing it is called as capitalization of reserves. What is the other way of saying it? Very good. Capitalization of reserves. Barbeko. Yeah, bonus issue is capitalization of reserves. It was old CA inter chapter. Now, bonus issue from the perspective of the company, it is called as capitalization of reserves. However, from the perspective of shareholder, it is called as free share. What do we mean when we say capitalization of reserves? In the balance sheet, there is share capital, there is reserves and surplus. We take it from reserves and surplus, put it to share capital. We take it from reserves and then put it to capital. Now the question is, what reserves can we take? Reserves are plenty, available in plenty, names are plenty, balances will be plenty. The order is fixed. What is the order in which we can use the reserves? Number 1, we should use CRR, Capital Redemption Reserve. If in case Capital Redemption Reserve is over, exhausted or not there, then we should use Security Premium. Sir, can I use Capital Reserve? No. After Capital Redemption Reserve, we should use Security Premium. What if Security Premium is not there or Security Premium is not sufficient? After you utilize Security Premium, if you still need money, then you should go to Capital Reserve. Sir, P&L, after you utilize Capital Reserve, if it is insufficient or it is not there, then you will go to Free Reserves. Sir, Free Reserves andre General Reserve and P&L account. Sir, can I first use General Reserve? No. You have to always first use CRR, then Security Premium, then Capital Reserve, then Free Reserves. That is General Reserve and P&L. There also we should first use General Reserve and then P&L account. Lot of questions will tell very clearly with minimum utilization of Free Reserves. That they don't have to tell. Anyways, we do like this only. Are you getting it? Very good. The next important thing that I want you to notice, Security Premium and Capital Reserve will be utilized only and only if it is realized in cash. I'll repeat. Security Premium and Capital Reserve can be utilized only and only if it is realized in cash. If in case your Security Premium is not realized in cash or your Capital Reserve is not realized in cash, we cannot use it for the purpose of bonus issue. Can we use it for bonus issue? No, we cannot. What do you mean by Security Premium realized in cash? You have issued shares for cash and you collected premium. That premium can be utilized. What if you issued shares for non-cash consideration and you collected premium? Can that premium be utilized? Hey, no. You can utilize only such premium money what is received by issue of shares for cash. So how do we get to know? They'll tell in the question. If they don't tell anything, we will always assume that premium that is there in the question is realized in cash. Second point, I told capital reserve we should check if it is realized in cash. Only if it is realized in cash we can use. If it is not realized in cash we cannot use. We will always assume that capital reserve is not realized in cash unless they specifically mention that it is realized in cash. I'll repeat, we will always assume that security premium is not realized in cash unless they specifically mention in the question that it is realized in cash. Because capital reserve will usually have revaluation reserve, forfeiture of shares, profit, all of this, which is actually not realized in cash. Got it? Yes or no? Very good. Then we'll see what is it that we need to note when it comes to share capital. Share capital in the sense equity share capital or preference share capital. You can actually make bonus issue for both. There is no legal law restricting you to make bonus issue for preference shares, but all our questions that we'll have will be usually equity shares. As this is one company which made bonus issue preference shares. Okay, skip that part. Then let's quickly see the accounting part. Sorry, effects of bonus issue ella beda time iga illa. Let's see types of bonus issue. There are two types of bonus issue. How many types of bonus issue? One is issue of fully paid up share as bonus. Second one, conversion of partly paid up share to fully paid up share as bonus. Let me repeat. There are two types of bonus issue. Number one, issue of fully paid up share as bonus. Number two, conversion of partly paid up share to fully paid up by way of bonus. Now, whenever we are issuing a fully paid up share as bonus, we are allowed to use all the reserves. We can use CRR, security premium, capital reserve, general reserve, P&L account. However, if you are converting partly paid up shares to fully paid up, let me repeat, if you are converting partly paid up shares to fully paid up, we are not allowed to use CRR and security premium. We are not allowed to use CRR and security premium. We should only use CR, that is capital reserve, general reserve and P&L. We cannot use capital redemption reserve. We cannot use security premium. Did you understand this? Akka. Very good. Sir, what do we mean by conversion of partly paid up share to fully paid up? See, share is of rupees 10, called up rupees 8, paid up rupees 8. 2 rupees not called, not paid. 2 rupees not called, not paid. I will make share call account debit to share capital account, but I won't collect cash. I'll write reserve account debit to bonus account debit to share call, and then without collecting 2 rupees, I'll make your share fully paid up. That is conversion of partly paid up to fully paid up. What is fully paid up? You have 2 shares of rupees 10 each, fully paid up. I'll give you 1 share of rupees 10 each, bonus. That is issue of fully paid up share as bonus. There is one mistake that students do. In the balance sheet, there is shares of rupees 10 each, rupees 8 paid up. Shares of rupees 10 each, rupees 8 paid up. Can the company make fully paid up share as bonus? Shares should be fully paid up to make bonus issue. What will they do? They will call 2 rupees. They will collect 2 rupees. They will make that share into fully paid up. Then they give bonus. Type 1 or type 2 Nado? Type 1. Type 1. Why? They called for money. They received money. Once they called for money and they received money, shares became fully paid up. Shares became fully paid up. No, there are fully paid up shares. You are making issue of fully paid up shares as bonus. You collected cash, no? If the company asks for 2 rupees but doesn't collect 2 rupees, convert that partly paid up share to fully paid up without collecting cash. That is type 2. Did you understand this? Let's see the journal entry. Journal entry. Issue a fully paid up share as bonus. We can use no CRR, security premium, capital reserve, general reserve, P&L account. Reserve is decreasing, debit. Capital is increasing, credit. But we will route it through a dummy account called as bonus to shareholder account, which will get nullified there only. So tell me, what is the journal entry for issue of fully paid up share as bonus? CRR, security premium, capital reserve, general reserve, P&L account debit to bonus. Then bonus account debit to share capital. Got this? Very good. This is issue of fully paid up share as bonus. Next, what is the entry for issuing partly paid up share as bonus? We will first make the call. Share call account debit to share capital. Share call account debit to. Then I'll write capital reserve. We can write. We cannot write CRR and security premium. Capital reserve, general reserve, P&L account debit to bonus to shareholder. Then bonus to shareholder account debit to share call account. So I won't receive money. See, share call will get nullified. Bonus will get nullified. Capital will increase, reserve will increase. So ultimately, whenever you do bonus issue, what is happening? Capital of the company is increasing, reserves of the company is decreasing. I'll repeat, capital of the company is increasing, reserves of the company is decreasing. This is what we mean by conversion of partly paid up share to fully paid up by way of bonus. Did you understand this? On this you would have to do some problems, and if in case they've asked you to do balance sheet after bonus issue, in the balance sheet that you prepare after bonus issue, you have to make one mandatory disclosure. What is the disclosure? How many shares are issued for non-cash consideration, that is by way of bonus. How many shares are issued by non-cash consideration, that is by way of bonus, that has to be disclosed in the face of the financial statements. Understood that? Now we would have to see right issue. Before that, shall we quickly see the question from our RTP? Is there a question on right issue, bonus issue? Let's see. See, there's one question on issue on forfeiture, debentures, bonus issue and right issue. Is the bonus or right? Call money was received, bonus issue. Shall we do this bonus issue question? What? Come on, Marana. XYZ Limited. XYZ Limited. We're solving question number 16. I think this is bonus issue and right issue, or only bonus issue? Only bonus issue. XYZ Limited. Are you ready? Now, the company has issued and subscribed capital. We will not waste time. Come to the end. On 1st of April 2023, company has made final call of rupees 2 for each share of 1 lakh. 1st of April. How much is the shares paid up? Preference shares, equity shares. 1 lakh shares of rupees 10 each, rupees 8 paid up. They are making call of 2 rupees. Shall we write the entry? What is the entry for making call? Share call account debit to share capital account. So 1st of April 2023. I will write the entry as share final call account debit to equity share capital account. 1 lakh shares into 2 per share, 2 lakh, 2 lakh. 1 lakh shares into rupees 2 per share, 2 lakh, 2 lakh. Do you get this? After 1st of April, that transaction. The call money was received on 15th of April. The money was received on what date? 15th April. So I'll write 15th of April, bank account debit to share final call, 2 lakh, 2 lakh. We have received money correctly. Got it? After this transaction, what is the next one? Thereafter, company decided to make bonus issue of equity shares at the rate of 1 share for every 5 shares sold. How many shares are giving as bonus? 1. For how many shares sold? 5. Let me write the ratio and do working mode. If you hold 5 shares, company will give 1 share. If you hold 5 shares, company will give 1 share. How many shares do we hold? Does the company have now? 1 lakh. How many? If there is 1 lakh shares, how many shares should they give as bonus? 1 lakh into 1 divided by 5. 20,000 shares. How many shares? Very good. Now let me write here bonus issue. This is 20,000 shares of rupees 10 each. That will come to 2 lakh rupees. 20,000 shares, each share of rupees 10 each comes to 2 lakh rupees. This is the money that we want. What reserves can we take? Is this type 1 issue or type 2 issue? Type 1. We are issuing fully paid up share as bonus. Why? We received cash for that partly paid up part. That is not free. Now, we'll use CRR. Is there CRR in the question? No. So, no CRR will be utilized. Illa. Next, security premium. Is it there? Yes. See, they've told collected in cash 25. Shall we use full 25? Yeah. Full 25 we will use. How much more do we need? We still need 1,75,000. Next, capital reserve with Illa. Is capital reserve? Not there. Then we'll go to general reserve. General reserve is 2,40,000. How much do I need? 1,75,000. Shall I take 1,75,000? Take how much is needed. Don't take more than that. P&L we won't go till there. So security premium and general reserve will decrease. Am I right? So I will debit security premium and general reserve account. Sir, idu 0. Sir, why are you still writing? Hage nimage gottagli anta. So this I will credit it to one account called bonus to shareholders account. This is temporary account, which will get nullified because immediately I am going to debit bonus to shareholders 2 lakh and create my equity share capital by 2 lakh. Obviously, I just told the same thing. You want me to delete it? I wrote it with an intention that you would know that if it was there, we would have utilized. Happy? Okay, done with this, everyone? That's it. This is the question on bonus issue. They can ask you for conversion of partly paid up to fully paid up also. Yeah. So there is a more detailed video on bonus issue. I'll share it to you on the Telegram group later. A 20 minutes video with all the adjustments and detailed explanation of bonus issue. It's a private video. So I'll share it to you people on the Telegram. Okay. So at the end, I'll tell you the Telegram access link. So we're done with bonus issue topic. Done. Can I go to right issue? There is no question on right issue in your RTP. But I'll still help you with right issue and then go to redemption of preference shares. Is that fine? What do you mean by right issue? Unlike bonus issue, in right issue, we are not going to give the share free. We are going to give a right to buy the existing share. We are going to give the right, eligibility to buy the existing share. If the shareholder wants to buy, they can buy. If the shareholder doesn't want to buy, they need not buy. Why do they buy? See, you hold certain percentage of shares in the company, 20%, 30%, 40%. You hold 20% shares in the company or you hold 30% shares in the company. Whenever the company goes for further issue of shares, what happens? If you don't buy, somebody else will buy. If somebody else buy, you had 20% share, it will become 15%. You had 60% share, it will become 40%. So you don't want to decrease your percentage of holding in the company. In order to ensure that your percentage of holding in the company doesn't drop, we go for right issue. Got it? Okay, come on. Let's see right issue in detail. It's an option given to the existing shareholder, not an obligation. Because of right issue, the existing shareholder has what? Option to buy the shares of the company, but is under no obligation to buy the shares of the company. Got it? I'll share the video at then. You can take screenshots from the video completely, how much you want. Okay, don't worry. Now try to understand. Relax. I will share. I won't say I will share and then I will say I won't share. I won't do that. I'll share. Trust me. I'll share on bonus issue, right issue, redemption of preference shares. Debentures I have not recorded one, so I can't share. If I would have recorded that, I would have shared that also. Now, the shareholder has an option to buy. He can buy, but he need not buy also. He can renounce the option also. He can give up that option also. Now, focus on this. There's a company with 20,000 shares. There's a company with, in this company with 20,000 shares, Beam holds 10,000 shares, Chutki holds 7,500 and Raju holds 2,500. 50%, 37.5% and 12.5%. Understood? Let's say the company is going for expansion and the company wants to issue additional 10,000 shares. If the company doesn't do right issue, you know what would happen? And this entire 10,000 shares are bought by Kalia. Now, company share capital is 20,000. In that Beam holds 10. Kalia owns 10,000. Chutki owns 7,500. Raju owns 2,500. So, Beam, who held 50% of the shares in the past, now he holds only 33.33% of the shares. Don't you understand that his percentage of holding is dropping from 50 to 33.33? And Chutki, whose share was 33.3, has dropped to 25. So now Kalia is equal majority in the company. If Raju or Chutki becomes friends with Kalia, then they become majority. They can take any decisions in the company. Beam doesn't want this to happen. He doesn't like it, Chutki talking to Kalia. So what does he do? He will say Kalia should not enter Dholakpur only. He'll say that the right issue has to be made by the company. When the right issue happens, observe, how many shares are there in the company? 20,000. How many shares is the company issuing? 10,000. So they're issuing 10,000 shares when the shareholding in the company is 20. So company will make one right share for every 2 shares held. Company will give one right share for every 2 shares held. How many shares does Beam hold? 10,000. He'll get to buy 5,000 rights. He has an option to buy how many shares? If he buys 5,000 shares, his shares will become 15,000. And Chutki's shares now will become 7,500 plus 3,750. And Raju's shares will become 2,500 plus 1,250. And their percentage of holding will be same again. If they buy the shares in the same proportion in which they hold, that option to buy the shares in the same proportion what the company gives is called as right issue. Did you understand right issue? It is the option given by the company to buy the shares in the same proportion to the existing shareholders. Did you understand? Here, as a shareholder, no, you have 3 options. FX Anla Beda. As a shareholder, no, you have 3 options. You can either buy the shares or you can sell the right, not the share. What can you sell? Right will be sold, not the share. Or the third option that you have is do nothing. What is it? Do nothing. So why is it that you can sell? What is it you can sell? This will be understood by these important terms. One is cumulative right price. What is it? Cumulative right price. Cumulative right price is the market price per share before right issue. Cumulative right price is the market price per share before right issue. And then we have something called as theoretical X right price. What is it called? Theoretical X right price. Theoretical X right price is the market price per share after right issue. What is it? Market price per share after right issue. Now you think and tell me, whenever the company is making right issue, company will collect the money and then give share. I told you it is not free share. Is it free share? Company will collect the money and then give share. And the company is going to collect the money and give share. Think and tell me, will the company issue the share at the same price at which it's there in the market, or at a lesser price, or at a higher price? Lesser price. Company cannot offer rights at a price higher than market price. Why? If you ask them to pay more than market price, why will they buy? They'll buy from market. If you give it at market price also, they won't buy. You would have to offer it at a price lesser than market price. Now, market really share price is 100. Company is offering you right share at rupees 90. The moment you buy the share at rupees 90, now you have certain shares at 90 rupees, certain shares at 100 rupees. Am I right? Do you really think in the market still the share will trade at 100? Share will not trade at 100. Price will drop. Price will. So cumulative right price, that is the price of the share before right issue in the market, will be more than the theoretical X right price, that is the price of the share in the market after right issue. What will be the decrease in the price? It will be like this. Let us say you had 10 shares. You had how many shares? 10 shares. Each share you had bought at rupees 100 each. So 10 into 100. 1000 rupees is the value of your 10 shares. You had 10 shares. Each share you had bought it at 1000 rupees. 10 into 100. 1000 rupees is the value of your old shares. Let's say company gave you option to buy 5 right shares. How many right shares? Each share at rupees 90. You pay 5 shares into 90, 450 rupees. 5 shares into 90, how much do you pay? 450. You got 10 shares at 1000 rupees. You got 5 shares at 450 rupees. Together you have 15 shares at what price together? 1450. Yeah? 1450. No. 100 shares into 10 per share. No. 1000. Here you have how many shares? 5 shares at rupees 450. Yeah. 90. That is 450. So 1000 plus 450. Correct. No. 1450. For how many shares? 15 shares. Do 1450 divided by 15. 96 point. In the market, price will become 96.66. After that, 96.66 will become the price. What is cumulative right price in this example? 100. What is theoretical right price in this example? 96.66. Per share, the share value went down by 3.33. 3.33 rupees per share, the price went down. No. Do you get this? If you do nothing, if you don't buy, if you don't sell, you lose 3.33 rupees. If you do nothing, you lose 3.33 rupees. Why? You had 100 shares at rupees 10 rupees each. 1000 rupees was the value of your portfolio. After right issue, each share become 96.66. No. Now you have 10 shares at rupees 96.66. The value was 1000 before right issue. Because you didn't buy right shares and you didn't sell rights, the value has become 966.67. You lost 33.33 rupees. How do you compensate that 33.33? Company gave you right to buy 5 shares. Company gave right to buy 5 shares that you would have to sell in the market. Somebody else will buy that and then buy the share from the market. Company. So that is there. No, that is called value of right. What is it called? That is difference between these two. Theoretical X right price and X right price. Sorry, cumulative right price and theoretical X right price. Difference between those two is called as what? Value of right. How do we find theoretical X right price? I told you, no, cumulative right price what you have. Sorry, cumulative right price multiplied by existing shares plus number of right shares multiplied by right issue. Whole divided by old shares plus new shares. That will give you theoretical X right price. Difference between cumulative right price and theoretical X right price is value of right. Did everyone get this? So there is more detailed video with these numbers, and then with these numbers I'll show what will happen in each of the cases. See that if I try to do that now, it will become too much time. But if you see this part of discussion, no, whatever is there here, same example extension. If you see this, then you will get full clarity on right issue. Any problem on right issue you will be able to do. So I'll share this video link to you people in the Telegram channel later. For now, can we go to redemption of preference shares? Say something. 8, 10, 20 minutes is there. So we have two topics in hand. One is redemption of preference shares. Another one is redemption of debentures. Madana. Let's go to redemption of preference shares. See, company whenever it issues shares, it is allowed to redeem the preference shares. You cannot buy back preference shares. A company can buy back equity shares and redeem preference shares. And initially it was an option, but now it is not an option. Now it is a mandatory condition. A company has to mandatorily redeem preference shares within a period of 20 years from the date of issue. Once the company issues the shares, maximum period is how much? 20. Maximum period is how much? It can't be for more than 20. Within 20 years, company has to redeem preference shares. It has to redeem preference shares. Did you understand this? Redemption of preference shares is actually nothing but ulta of issue. It is opposite of issue. This is preference share meaning. See, redemption of preference shares, issue of preference shares. Whenever the company issues preference shares, its share capital will increase. Correct or not? People give money, company collects money, company gives share. This is issue of shares. Company's capital will increase, company's cash will increase. Redemption is ulta. Company will take the share back from the shareholder and give them money. This is redemption. So in the event of redemption and issue, what happens? In the event of issue, share capital will increase, cash will increase. In the event of redemption, share capital will decrease and cash will decrease. Did you understand? So for issue, what is the entry? Cash account debit to share capital. Am I right? For redemption, the entry will be share capital account debit to cash. When we write share capital account debit to cash, we cannot straight away write share capital account debit to cash. We need to write share capital account debit to shareholder, shareholder account debit to cash. At the time of issue, can you issue at par? Yes. Can you issue at premium? Yes. Similarly, redemption, can you redeem at par? Yes. Can you redeem at premium? Absolutely yes. But redemption at discount is not allowed. You need to comply with certain provisions of Companies Act before you go for redemption. The conditions are that should not exceed 20 years. Mandatorily within 20 years you have to redeem. Second one, the money that is paid to this premium, no, it should come out of what? Sorry, the money that is used for redemption can either come out of divisible profits or by way of fresh issue. Then if the shares are to be redeemed, the shares should be fully paid up. Shares should be partly paid up. Preference shares cannot be redeemed. Sir, what to do if the share is partly paid up? Call for the balance money, collect the balance money, make the share fully paid up, then do redemption. Then if there is any premium that you want to pay on redemption of preference shares, that premium has to come only and only from P&L. If you are redeeming preference shares at premium, that premium has to come only and only from P&L. Sir, what if there is no balance in P&L? Then you cannot redeem preference shares at premium. There is one exception allowed for a company where accounting standards are not applicable. So that is not there. You ignore that. So whenever the company has to redeem preference shares at premium, premium should come from P&L. There should be balance in P&L. If there is no balance in P&L, no redemption at premium. You should do redemption at par in that case if you don't have enough balance. Okay, got that? Then, so whenever the company is redeeming its preference share capital will decrease. A company's capital is decreasing. A company's capital can never decrease other than by way of reconstruction approved by scheme of court. Otherwise, another company's capital should not reduce. So let's say 10,000 rupees worth of equity shares are there, 10,000 rupees worth of preference shares are there, 10,000 worth of preference shares are redeemed. Now capital will reduce from 20,000 to 10,000. To ensure that such decrease in the capital won't happen, to the extent capital is decreasing, we should create CRR. What do we create? CRR. CRR is capital redemption reserve. What is CRR? Capital redemption reserve. And this CRR will be utilized only and only for the purpose of bonus issue. When we use CRR and make bonus issue, capital will increase. So I redeem preference shares worth of 5,000. How much CRR should I create? 5,000. I redeem preference shares worth of 10,000. How much CRR should I create? 10,000. Because 5,000 capital decreased, 5,000 I created CRR. Using this 5,000 CRR, I will make bonus issue. Capital will increase by 5,000. If I redeem preference shares for 10,000, I create CRR for 10,000. Using the 10,000 CRR, I'll redeem preference shares 10,000. Sorry, I'll create CRR. I'll make bonus issue of 10,000. capital will increase. The only place where CRR need not be created is to redeem preference shares of 10,000. I issued equity shares of 10,000, collected the cash and I redeemed preference shares. So I issued equity shares, I collected cash. I redeemed preference shares, I paid cash. So my capital is not decreased. Because of issue of equity shares, capital has increased. Because of redemption of preference shares, capital has decreased. I don't have to create CRR. I don't have to create. What if redemption of preference shares is 10,000? Issue of equity shares is 8,000. Should I create CRR? Answer is yes, I have to create CRR for 2,000. Understood that? Very good. So what will be the accounting entries for the purpose of this? I told you the sources of funds. Sources of funds can come from internal funds or external funds. Internal funds means using cash or sale of assets. External funds means issue of shares. If we use internal funds, we create CRR. I told you this. Then let's quickly see. This part I'll explain later. Now we'll see the journal entry first. Accounting for redemption. Whenever we do accounting for redemption, it will look like this. Preference share capital account debit, premium redemption if it is there debit to preference shareholder, what we are supposed to pay. Later we'll debit preference shareholder account debit to cash account for the amount paid. And that premium whatever we've debited, it will be adjusted against P&L account. And because we are doing redemption from internal funds, we have to create CRR. CRR will be created from free reserves, that is general reserve and P&L account. However, if you are doing this from fresh issue for the purpose of redemption of preference shares, you are getting the money by way of fresh issue. Then we'll first write the entry for fresh issue, bank account debit to share capital. Then we'll go for redemption, preference share capital account debit, premium account debit to preference shareholder. Then preference shareholder to bank payment. Now we have to create CRR but not for full amount. You know why? Here some amount of capital increased, here some amount of capital decreased. Here let's say the decrease is 10, increase is 8, we'll create CRR for only 2. What if the increase is 10 and decrease is also 10? No need of creating CRR. Only to the extent to which the CRR is decreasing, only to the extent to which the capital is decreasing in net, no, there we do CRR. Here there is no decrease, there we don't do CRR. Here it is partly from internal funds, partly from external funds. So we create CRR for the differential amount. Are you getting it? So I was trying to show you all the three cases. Fully out of divisible profits, fully out of fresh issue, partly out of fresh issue and partly out of reserves. How to do? All the three cases. You got it? Then, this is a very tricky question. In CA intermediate, people find it annoying and difficult there also. I'm going to tell you how to do it with the help of a very simple shortcut. Shall I? This is where the question is about. They won't tell you how many shares to issue. They will ask you to compute how many shares are to be issued. They will not tell how many shares are supposed to be issued. They will ask you to issue minimum number of shares to arrange the funds for the purpose of redemption. Now, why are we issuing shares? Why are we issuing shares? Two reasons can be there. Number one, we don't have cash. We don't have. Number two, we have cash, but we don't have enough free reserves to create CRR. See, we have 10 lakh rupees cash. Redemption need to be made is 2 lakh. From 10 lakh cash, I'll pay 2 lakh and redeem my preference shares. But when I redeem my preference shares being 2 lakh cash, 2 lakh rupees capital has decreased. I should create CRR. To create CRR, reserves illa. Reserves. So though I have 10 lakh rupees cash, I can't redeem my preference shares using cash. I have to go for fresh issue. Sometimes what will happen? I don't have cash. I have 10 lakh rupees reserves to create CRR, but I don't have cash to redeem. Then I'm making fresh issue for the purpose of cash. So whenever the company asks you to make fresh issue of equity shares to raise money for the purpose of redemption, you need to ask yourself one question. Is it because there is shortage in cash, or is it because there is shortage in reserves to create CRR? If it is because there is shortage to create, if it is because there is shortage to create profits for the purpose of CRR, then first you take nominal value. Why? CRR is created to the extent of nominal value. And from this nominal value, how much ever divisible profits are available, no, you deduct that profits available. Are you getting it? Once you deduct that, whatever value we get, no, that is the funds that should be raised by way of fresh issue. See, let's say we have 2 lakh rupees worth of reserves. How much is the reserves that we have? We can create CRR to the extent of 2 lakh. But preference shares redeemed is 10 lakh. 10 lakh is the CRR should be created if we redeem fully out of internal funds. 2 lakh is what we have. How much is shortage? 8 lakh. How much is shortage? So to the extent of 8 lakh, you have to make fresh issue. To the extent of 8 lakh, you have to make that 8 lakh should be divided by nominal value of shares. Remember, 8 lakh should be divided by nominal value, paid up value. Don't include security premium. Nominal value, that is paid up value, not security premium. However, if the money is shortage, if you have sufficient reserve, if the shortage is money, then we will take redemption value of preference shares. How much money should we pay for preference shareholders, including premium? From that, we deduct the cash available. After I deduct the cash available, I'll get the shortage of cash. No. This will be divided by not paid up value, but premium also will be included. Issue price is what I'll divide it by. Shortage of cash, denominator issue price. Shortage of reserves, denominator paid up value. This is what you should remember. If you see questions, some questions they would have taken nominal value, some questions they would have taken issue price. You will get confused when to take nominal value, when to take issue price, because they don't clearly mention what is the shortage there. Once you spot this difference, no, the problem will become very, very simple and soothing. Did you understand this? Yes. So if you have done questions on redemption of preference shares, you will be able to connect to this. If you have not done questions, you will be like, sir. You get this? This is what you should know when it comes to redemption of preference shares. So we are at 8:20. Oh my god, exact 10 minutes. At 8:10, I told we have 20 minutes left. So we are done with redemption of preference shares in this case. Did you all understand this? Okay. This also, there is a separate video about 25-30 minutes. Detailed discussion, point by point, everything. I'll share that to you people later. I'll tell you where will I share at the end of the video formats. So did you understand this redemption of preference shares? Can I go to the last topic, redemption of debentures? Very good. Come on, let's go to redemption of debentures. 2 points what you must know when you come to redemption of debentures is: number 1, 10%, number 2, 15%. Don't get confused between 10% and 15%. What are the two numbers? 10% and 15%. 10% and 15%, don't get confused. 10% is the extent to which DRR should be maintained. 10% is the extent to which DRR should be maintained. Debenture redemption reserve. This is the profits kept aside to ensure that we will have sufficient money to repay debentures at the end of their term. I'll repeat. Debenture redemption reserve is appropriation of profits by transfer to reserves. This is done to ensure that we will have sufficient money to repay our debentures at the end of their term. Got it? This should be maintained to what extent? 10% of nominal value of debentures. 10% of nominal value of debentures. And this will be created out of free reserves. Got it? Then we have debenture redemption reserve investments. What is investment? Now, if I have to pay money to buy debenture holders, I want cash. Sumne aage cash itre kharchaagbidutte. You won't keep cash, no, too much. You will say, if I keep too much cash, I'll spend it. So I'll freeze it somewhere. That freezing is investment. So what do? You bought money from debentures. You used it for business. You have to repay them after 5 years or after 10 years. Little money will be arranged every year. It's not like 10 years later all of a sudden you get money. Little money should be saved every year, no, to arrange for funds after 5 years for redemption. This year you saved little money. What should you do with that money? You should keep it in DRR investments. Where do you keep it? DRR. This DRR investments will not be like investment where 21 din mein paisa will become double. No, this should be safe investments. What is it? Safe investment. Government bond, RBI treasury bill issued, or any other bonds issued by any banks. It should be safe investment. You get it? So we'll keep that. First year we'll keep little, second year we'll keep little, third year we'll keep little, fourth year little, fifth year little. Over 5 years you kept little. 5 years over. Now we have to do redemption. You know what do? Sell all the investments, collect the money, use that money to pay debenture holders. I'll repeat, every year little money will be kept in DRR investments. At the end of the debenture term, we'll sell all the DRR investments, receive the money, use that money to repay our debenture holders. This has to be maintained at minimum of 15% of debentures to be redeemed in the current year. This year we are going to redeem some debentures. This year if you are going to redeem at the beginning of the year, for the debentures what you are going to redeem in the current year, minimum 15% should be there in DRR investments in the beginning of the year. You have to maintain. You have to maintain. On the redemption date, you sell the investments, you redeem the debentures. Did you understand this? Yes. This is actually very interesting and complex topic in CA Inter, where we have an option of buying our own debentures, we'll pay interest on our own debentures to ourselves and everything. Now, because they've brought it to foundation, they can't ask you question on interest on debentures part, because To do that interest on own debentures, you have to learn accounting standard 13, which is part of inter syllabus. So it's become a very plain sada sida chapter with some 3-4 questions in your material. Do those 3-4 questions only, you will get one among those 3-4 only. There can't be any creative way of asking questions. I'll do one question from your material, however. Don't worry. So whenever you are going to create DRR, I told you it is created out of free reserves. Reserves will decrease, free reserve account debit. Debenture redemption reserve will increase, DRR account debit to credit. So the entry will be free reserves account debit to DRR account. You get this? DRR investments are purchased. What will be the entry? Investment is an asset increasing. So DRR investment account debit. Credit will be given to bank account. Why will we credit bank account? Because investments are purchased by paying cash. Let us say at the end of the period, debentures are due for redemption. You will write X% debentures account debit. Nominal value of debentures decreasing. Premium whatever you are supposed to pay, add. This money will be crediting into debenture holders account because debenture holders are our liability now. We have to pay so much money to our debenture holders. Then finally when you make the payment, you will write debenture holder account debit to cash. And when you do this redemption, this DRR what you created is no longer required. You created DRR with an intention of safeguarding the money for redemption. When redemption is over, DRR is no longer required. So DRR whatever you have already created will be reversed. Henge, same entry. Here we wrote free reserve to DRR, no? There will write DRR to general reserve. Did you understand this? That is the entry that you should write. They have given question where you had debentures. First question in our study material. This is our ICA study material question. So debentures in our balance sheet was 10 lakh. These are supposed to be redeemed. So this debentures is closed by transfer to debenture holder account 10 lakh. And in our debenture holder account, I will write 10 lakh rupees is supposed to be paid to them. In the question they have told that we need to pay them premium of 10%. So the 10% premium I will add. So 1 rupee premium, 1% premium ansate. 1 rupee per debenture premium they have told, I will add that premium. Full money I will pay. So debenture holder account will get closed. I will repeat the entries. Entry number 1, debenture account debit to debenture holder account. In debenture account I wrote to debenture holder. In debenture holder account I wrote by debentures. Premium needs to be paid. It is expense. Premium account debit to debenture holder account. So premium is debited in debenture holder. And that is paid debenture holder to bank. In debenture holder account, I wrote by premium. In premium account, I will write to debenture holder. And like I told, this will be changed to P&L account only. During the year, there are 2 more transactions. DRR is created. Investment is purchased. Investment is sold. DRR is reversed. Ashte, torasti nodi. They have created DRR. Balance opening was 50. 50,000 was created during the year. So we will write 50,000 DRR opening balance. DRR created during the year 50,000. Then at the 10%, no, DRR should be maintained at 10%. So 10% they have created DRR here. And redemption over, DRR is no longer required. DRR is transferred back to general reserve. Understood? And they purchased investment, sorry, they had investments worth 1,50,000. To redeem debentures, they sold investments for 1,50,000. One debenture account, one DRR account, DRR investment, bank account and debenture holder. Everything is simple. In debenture account, opening balance credit, transfer to debenture holder. Debenture holder will come from debenture account, debenture premium, payment. In DRR account, creation of DRR, reversal of DRR. In DRR investments, opening balance plus purchase if there is any, minus sale, that's it, closing. That premium you bring it to DRR premium account, sorry, premium on redemption of debentures and then transfer it to P&L account, close it, over. Is it difficult? No. I'll tell you which problem will become difficult. I think it is second problem or third problem, which is interesting. Third problem, no? Conversion. Third question, which had that conversion and everything. Third one, we didn't do journal entries, no, that day. Fast track question, we were discussing third question, okay, third question. We'll see the third question from our material. ICA study material. I won't take too much time, guys. Another 5 minutes. It is 8:30. I know. I know it's 8:30. 5 minutes. Aren't you feeling good that we did so much? Imagine you sitting and studying for so long. Would you finish so much in such less time? Now don't sit with your friend to study later. ಆಲ್ವೇಸ್ ಡೂ ಇಟ್ ಅಲೋನ್. ಪಾರ್ಟ್ನರ್ಶಿಪ್ ಅಲ್ಲಿ ಓದಿದ್ರೆ ಮಾರ್ಕ್ಸು ಪಾರ್ಟ್ನರ್ಶಿಪ್ ಅಲ್ಲಿ ಬರುತ್ತೆ. 60 marks ಫಾರ್ ಯು ಅಂಡ್ ಯುವರ್ ಫ್ರೆಂಡ್ ಟುಗೆದರ್. ಜೊತೆಯಲ್ಲಿ ಓದಿದ್ರೆ ಹಂಗೆ ಹೋಗೋದು. ಸೊ ಹಂಬಲ್ ರಿಕ್ವೆಸ್ಟ್, don't try to study together. Separate you study. Together don't study. See, second question is also very similar to that. Third one is a very interesting question. See, look at third one. Here there is no journal entry. It's too much of mathematics types. So word problems used to be there in school, no? Atara irritate agate. But very easy if we decode it. Shall we decode this? See, XYZ Limited had issued 1012% convertible debentures of rupees 100 each. Redeemable after a period of 5 years. How many debentures are issued? 1000. According to the terms and conditions, these debentures were redeemable at a premium of 5%. When they collected 100. When they are repaying, they'll pay 105. Okay. The debentures also had an option for conversion. Option at a time of redemption to convert 20% of their holdings into equity shares. So if they want, you have 10 shares, you have 10 debentures. You can convert 20% of your holding to equity shares. Balance you have to take cash only. So they have an option to convert 20% of their holdings to equity shares. It is not like you have 10 debentures, you will get 2 equity shares. 2 equity shares alla. 20% of your holding will become equity shares. How many equity shares? We don't know. That depends upon rate of issue. I am not telling you 10 debentures only, 2 debentures will become 2 equity shares. It will not become 2 equity shares. The value equal to 2 debentures can become equity shares. How many equity shares? That depends upon the rate of issue. At which issue price are they issuing? Okay. Then holding into equity shares of rupees 10 each at a premium of 20. At what premium? 20. So issue price is 30. Sorry, at a price of 20 per share. So issue price is 20. Issue price is how much? 20. And the balance in cash. Debenture holders amounting to 20,000 opted to get their debentures converted into equity shares. Now, if they decide 20,000 worth of debenture holders, they won't get it is not original amount into this one and they'll get full equity shares. Among that 20,000 rupees, 20% will become equity shares. Some investor who's holding debentures worth rupees 20,000 has opted for conversion into equity shares. Full 20,000 won't become equity shares. 20% of the 20,000 will become equity shares. Did you understand? Observe. How many debentures are there? 1000. Nominal value. One second. Let me make it nice. Now it will become nice. Number of debentures in the question. 1000. Nominal value. Total nominal value? 1 lakh. Nominal value for conversion is how much? How many people opted? Person holding how much nominal value opted for conversion? 20,000. Did you get this? Now, nominal value per debenture is how much? 100. Am I right? So 20,000 divided by 100. Number of debenture holders opted for conversion is how much? 200. Debenture holder holding 200 debentures opted for conversion. Number of debentures to be converted is how much? 200 into 20%, 40. 200 into 20%, 40. Did you understand this? Now, what is the price at which the shares are to be, debentures are to be redeemed? 5% premium ante helidare. 5% premium. 105 will become the price. Conversion value is 40 debentures into 105. 4,200. For 4,200 rupees, you will get equity shares. Each equity share is 20 rupees. So how many equity shares will you get? Value 4,200, issue price 20. That's what I was trying to tell. What we usually think, no, 20,000 andre 200 shares, 200 debentures. 200 debentures of 40 means 40 equity shares sigutte. 40 equity shares sigodilla. To the extent of 40 debentures, you are eligible for equity shares at its issue price. Did you understand this? So I'll repeat, 20,000 is nominal value, which means 200 debentures. Am I right? And in the 20% are eligible for conversion to equity shares. How many debentures will get converted? 40. 40 into 105. 4,200. 4,200 rupees ge ಎಷ್ಟು equity shares ಬರುತ್ತೆ? 210, because one equity share is 20. You can do it another way also. Now 20,000 nominal value, it is redeemed at 105 premium. No, please do 20,000 into 105. percent. 21,000. In the 21,000 you do 20%. 4,200. I mean to say 20,000 is nominal value alva. We are ready to pay them 5% premium. So do plus 5%. We are supposed to pay them 21,000. In that 20% equity share agate. Alva. Do into 20%. 4,200 rupees equity share sigate. Each equity share is 20 rupees. So they get 210 shares. Journal entry they have not asked. Only thing is computation. 210 shares. Did you understand? What you need to remember is for that value of debentures, at the issue price you will get equity shares. No, you won't get one debenture, one equity share. Ashte. There is nothing else more difficult in your material. Fourth question, fifth question and all are journal entry based questions. Bank account debit to shareholder, shareholder account debit to share capital, issue of shares and everything. So only tricky question was that first question where ledgers were there and the third question where that conversion was there. I discussed both the questions in the class on redemption of debentures for you. Did you understand? Only things that we didn't discuss from our RTP is true or false question, journal entry question, cash book, petty cash, and other than that rectification we've discussed, BRS we've discussed, valuation of inventory we've discussed, bills of exchange we discussed, final accounts we discussed, incomplete records we discussed, partnership we discussed, company accounts we discussed, and NPO also we discussed. So except for the first 2-3 simple topics, we've covered the rest of the topics in the marathon revision video. And by this, like I told you, I'll take 5 minutes now. At 8:21 I told 10 minutes for redemption of debentures. 8:31 I told 5 minutes. It's 8:36 and we have rightly finished the topic of debentures. As I tell 8:36, it's become 8:37. So I finished on time. So did you people enjoy and then also learn this last 3 days of marathon revision? Roughly it will come to about 10-12 hours in our YouTube when it's been posted. So give us a day or two's time. It will be posted on YouTube with timestamps. You guys can watch it from there and also share it with whoever you feel like it would help. All I would like you people to do is please like your subject, please subscribe to the course, and please comment on a daily basis on your subject and not on the video. So ensure that you give 100% of the watch time to your books and then study with full dedication and full energy for the next 15-20 days, and trust me, no one is going to stop you from sitting in a CA intermediate class. You have it all within you to sit in CA intermediate class, so you should be feeling terrible if you don't make it till then. You deserve it, you have the energy, you have the focus, you have everything that it takes to reach there. By any reason, if you can't reach there, you can't blame anyone. You can't blame your teachers, you can't blame your parents, you can't blame institute, nor can you blame elections, or nor can you blame health or anything for that reason. So everything is in your control. Go on exile. No one should find you, no one should spot you. So just escape from the reality. Go to your hideout. You don't have to show your face, you don't have to shave, you don't have to cut your nails. So just have the food, become an early man, stay in the cave, just eat, study, sleep. Eat, study, sleep, eat, study more, sleep less. And then do whatever it takes to ensure that it will be fine. I'll tell you, when I was also a student, I also felt this moment where when you sit back and then try and study, everything in the planet looks so exciting, so nice other than studying. Even the staring at the bare wall becomes so exciting. You would hate the game of chess, but you like playing the game of chess during the time. So everything is nice. Talking to mom is so nice. Talking to random strangers on the street is exciting. Everything is exciting because you don't want to study. But I'm not telling you you will love to study. If you love it, amazing. You don't need anyone's help if you love. But if you don't like to study, I'll tell you something. Listen, you have picked this course and you have to complete this course. If you accept that you are a failure, if you accept that you are not a fighter, then don't study. Quit. You will fail, no problem. But if you think you are not a quitter, if you think you don't deserve to fail, if you think you are a person with courage and then focus that you don't want to let yourself go down and then accept failure, no, then you have to study right now. If you take a little relaxed mode, you would have to study for 3 months after exam. Ask yourself one question: 3 months or 15 days? 3 months or 15 days? Satru parvagila. Sit for 15 days and study. Because if you don't study for these 15 days, you might have to do the same thing for 3 months, guys. And in those 3 months, if you open any book, may it be law, may it be accounts, may it be quant, or may it be any subject, when you open, lot of pages will be like, I know this. I read this. Oh my God, I know every line of this. I can solve this problem. But you still fail. Then you don't know whether to study again or to not study. Why? You don't know. You should study again. Why? You failed. No, you should study. But you don't want to study. Why? You know it. Then it will become more of an irritation in those 3 months. Why? You know it, but you fail. See, if you fail, and you know that you don't know something, that is the reason you fail. It is okay. You failed, but you're like, how did I fail? How can I even fail? I know everything. How can I fail? If you get into that zone, no, why did I fail? And you're not able to find the reason why you failed, it is very bad. Because you don't have a solution to it. You get this? Only way to escape that scenario is don't try to get into that zone only. 15 days. 15 days. How many days left? 25 days. Okay, 25 days. Sorry, I don't cut my 25 minutes. So 25 days. 25 days. You can do anything. You can do anything possible. Even if your preparations were okay till date, no? In this 25 days, you can make miracles happen. And look around in the classroom. Look around in the classroom. Look around in the classroom. So these are the people with whom you are going to write the exam. And I'll tell you to look around when you go to inter. You should be able to see same faces. Yeah? If you miss anyone, then that means that that person has not given their 100% in this 25 days. You will miss them. And every batch, this does happen. I want one batch where you go to inter, you look around and say, all of us are here, sir, yaru missing. I want that. All of us are here, sir. You might call me a dreamer. I don't care. There's nothing wrong in dreaming. I have this dream. Bloody one day this dream will come alive. That day I'm living my dream. I don't want to live as a person who doesn't even dream. I have a dream. Very simple dream. Whenever we take any marathon revision, fast track or any batch, you look around and there are some 20 people, 30 people, 100 people, 200 people, how many number? Whatever number. And when you go to next level, we have all those people sitting there in that very room. And that makes a different kind of happiness. I don't want you to score 100 on accounts. It won't make me happy when one person scores 100 and 3 people fail. All I want is everyone being happy, everyone passing. And that's my simple request to you all. Do it for me at least, if not for you people. Remember that there's one guy there who's waiting for you to be happy and successful. And I'll be immensely happy if you guys can clear. But I've done whatever I could do till now. Only thing that I can do ahead of it from now is pray to Almighty for good results. So on June 1st also Hanuman Chalisa 10 times ಹೇಳ್ತೀನಿ ಅಂತ ಅನ್ಕೊಂಡಿದ್ದೀನಿ for the betterment of your results. So I will do whatever it takes from my side by including you all in my prayers. I hope you will also work enough hard to ensure that you clear your examination this very time. Got that? That's a simple message, guys. Did you learn something new today? Did you guys have little fun today? Remember, life is not a battle to be struggling. It's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? Yes. Are we in the game? Yes. Before I tell on the top of your voice, in order to come to Telegram, just open Telegram and then search accountsman, and then you'll find one. Just search one word called accountsman. You will find a web channel, and then if you come in there, when you come to Telegram, in the search icon, just search accountsman. When you search for accountsman, you will find one thing called accountsman for accounts, and here there is one link shared which says CA Foundation discussion channel. If you click on this CA Foundation discussion channel, it will take you here, and I will share the paper here. Is that fine? Very good. That's it. See you all here. Where was I? For one last time on this day, are we in the game? That's it, guys. Tada, bye-bye. Take care. See you all very soon at the next level. Till then, have a great time. Bye. Hey, before you leave, ಎಲ್ಲರೂ ಹೇಳೋದು ಒಂದೇ ನಮ್ದೆ. ಏನ್ರಿ 6 ವಿಕೆಟಾ? ನಂದ್ರಲ್ಲಿ 56 for 1 ಇದೆ. ಇಲ್ಲೇ ಸ್ಟಾರ್ಟ್ ಮಾಡೋಣ. Miracles do happen. Just believe in it. Karthik outa. I haven't seen you much in class before. You weren't part of the classes here. People watching it on YouTube, you do have a great time, guys. Bye.